Well, good afternoon. I think the students here may know who I am, but for those who are watching the broadcast, I'm Steve Knapp, president of George Washington University, and it's really a pleasure to welcome you to today's first class in a series entitled Reflections on the Federal Reserve and Its Place in Today's Economy, featuring the chairman of the Federal Reserve, Dr. Ben Bernanke. I'm pleased to acknowledge that we have with us two of the university's trustees, Nelson Carbonell and Mark Schenkman, and also a number of faculty members are here in the audience, and some of them will be teaching later in the series. Today is the first university lecture series delivered by a sitting chairman of the Federal Reserve, and I think it does provide an extraordinary opportunity for the students who are here in the classroom, but also for those watching online, to have an opportunity to gain insight into the nation's central banking system and a wide range of issues that affect this country and the world. I do want to say that there are microphones available for the students, and certainly encourage you, when the chairman's lecture is over, to avail yourself of those, and we hope there'll be a lively exchange of questions and answers at the end of the lecture. It's now a distinct honor to introduce the chairman of the Board of Governors of the Federal Reserve System, Dr. Ben Bernanke. Dr. Bernanke took office in 2006 and is now serving his second term as chairman. He also serves as chairman of the Federal Reserve's Open Market Committee. Before his appointment as chairman, Dr. Bernanke was involved with the Federal Reserve in several roles: as a member of the Board of Governors, as a visiting scholar, and as a member of the Academic Advisory Panel at the Federal Reserve Bank of New York. He also served as chairman of the President's Council of Economic Advisors from June 2005 to January 2006. Now, Chairman Bernanke is no stranger to academia. He's been a faculty member at Princeton, Stanford, and New York University, as well as the Massachusetts Institute of Technology. He's held a Guggenheim and a Sloan Fellowship, and is a fellow of the Econometric Society and the American Academy of Arts and Sciences. Chairman Bernanke received a Bachelor of Arts from Harvard University and a PhD from MIT. Ladies and gentlemen, please join me in welcoming the Chairman of the Federal Reserve, Dr. Ben Bernanke.
Thank you very much, President Knapp. Gee, this is great. This is what I used to do before I got in this line of work for 23 years, and I've always enjoyed engaging with college students, so thank you for being here, and I hope we do have a good conversation. Let me particularly thank President Knapp and Professor Fort and George Washington University. As everybody here knows, these lectures are part of a real course, and after I get off the scene, there will be other professors talking about other aspects of the Fed, and you'll hear different points of view, which is great. And you'll have to do some papers and all kinds of things, and I'm going to read a few of the papers. So I look forward to doing that. I'll be talking from slides, which is in part for the purpose of making this available to others who might be interested. These slides will be posted on the Federal Reserve's website, federalreserve.gov, as we go through. And so if you need extra copies, or by all means do that. And as President Knapp said, I'm going to be talking for a while from the presentation, but at the end I hope we can have some questions and answers. So when we get started. So what I want to talk about in these four lectures is the Federal Reserve and the financial crisis. Now, my thinking about this is very much conditioned by my experience as an economic historian. I think when you talk about the issues that just occurred in the last few years, it makes the most sense to think about it in the broader context of central banking as it's taken place over the centuries. So even though we're going to be focusing a good bit of the lectures, particularly next week, on the financial crisis and how the Fed responded, I think we need to go back and look at the broader context. So as we talk about the Fed, we'll be talking about the origin and mission of central banks in general. And we're looking at previous financial crises, most notably the Great Depression, and see how that informed the Fed's actions and decisions in the recent crisis. So let me just give you a roadmap of the four lectures. Today, lecture one, we won't touch on the current crisis at all. Instead, we'll talk about what central banks are, what they do, how central banking got started in the United States, and we'll do some history. We'll talk about how the Fed engaged with its first great challenge, the Great Depression of the 1930s. The second lecture on Thursday will take up the history. We'll review developments in central banking and with the Federal Reserve after World War II, talking about the conquest of inflation, the Great Moderation, and other developments that occurred after World War II. But we'll spend a good bit of time in lecture two talking about the build-up to the crisis and some of the factors that led to the crisis of 2008-2009. Then next week, we'll get into the more recent events. In lecture 3, we'll talk about the intense phase of the financial crisis, its causes, its implications, and particularly the response to the crisis by the Federal Reserve and by other policymakers. And then in the final lecture, lecture 4, we'll look at the aftermath. We'll talk about the recession that followed the crisis, the policy response of the Fed, including monetary policy, the broader response in terms of changes in financial regulation, and a little bit of a forward-looking discussion about how this experience will change how central banks operate and how the Federal Reserve will operate going forward. So this is our topic today, is origins and missions of the Federal Reserve. So let's talk in general about what a central bank is. If you've had some background in economics, you know that a central bank is not a regular bank, it's a government agency, and it stands at the center of the monetary and financial system of a country. Central banks are very important institutions. They have helped to guide the development of modern financial systems, modern monetary systems, and they play a major role in economic policy. Now, we've had various arrangements over the years, but today virtually all countries have central banks. The Federal Reserve in the United States, the Bank of Japan in Japan, Bank of Canada, and so on. The main exception is only cases where you have what's called a currency union, where a number of countries collectively share a central bank. The most important example by far of that is the European Central Bank, which is central bank to 17 European countries who share the common currency, the euro. But even in that case, each of the participating countries does have its own central bank, which is part of the overall system of the euro. So central banks are now ubiquitous. Even the smallest countries typically have central banks. Now, this is a very important theme here. What do central banks do? What is their mission? And as I'll discuss throughout the lectures, it's convenient to talk about two broad aspects of what central banks do. The first is to try to achieve macroeconomic stability. And by that, I generally mean stable growth in the economy, avoiding big swings, recessions, and the like, and keeping inflation low and stable. So that's the economic function of a central bank. The other function of central banks, which is going to get a lot of attention, obviously, in these lectures, is the financial stability function. Central banks try to keep the financial system working normally, and in particular, they try to prevent, or if unsuccessful in preventing, they try to mitigate financial panics or financial crises. And I'll talk more about what those are. Now, what are the tools that central banks use to achieve these two broad objectives? In very simple terms, there are basically two broad sets of tools. On the economic stability side, the main tool, as I'm sure everyone knows, is monetary policy. In normal times, the Fed, for example, can raise or lower short-term interest rates. It does that by buying and selling securities in the open market. Again, in normal times, if the economy is growing too slowly or inflation is falling too low, the Fed can stimulate the economy by lowering interest rates. Lower interest rates feed through to a broad range of other interest rates. That encourages spending, acquisition of homes, for example, construction, investment by firms, borrowing. It just generates more demand, more spending, more investment in the economy, and that creates more thrust and growth. So that to stimulate an economy, you lower interest rates. And similarly, if the economy is growing too hot, if inflation is becoming a problem, then the normal tool of central bank is to raise interest rates. So by raising the overnight interest rate, known in the United States as the federal funds rate, higher interest rates feed through the system and help to slow the economy by raising the cost of borrowing, of buying a house, of buying a car, or of investing in capital goods, and that will slow the economy and reduce the pressure of overheating. So monetary policy is the basic tool that central banks have used for many, many years to try to keep the economy on a more or less even keel in terms of both growth and inflation. Now, a little less familiar is the main tool of central banks in dealing with financial panics or financial crises. And that tool is the provision of liquidity. So to address financial stability concerns, and for reasons I'll explain, one thing that central banks can do is make short-term loans to financial institutions. As I'll explain, providing short-term credit to financial institutions during a period of panic or crisis can help calm the market, can help stabilize those institutions, and can help mitigate or bring to an end a financial crisis. So this activity, which is an old one, as I'll discuss, is known as the lender of last resort tool. So again, if financial markets are disrupted, financial institutions don't have alternative sources of funding, then the central bank stands ready to serve as the lender of last resort, providing liquidity to the system and thereby helping to stabilize the financial system. Now there's a third tool which the Fed has had from the beginning and most central banks have, which is financial regulation and supervision. Central banks usually play a role in supervising the banking system, assessing the extent of risk on their portfolios, making sure their practices are sound, and in that way trying to keep the financial system healthy. To the extent the financial system can be kept healthy and its risk-taking within reasonable bounds, then the chance of a financial crisis occurring in the first place is reduced. However, this activity, although I'll come back to it, this is something which is not unique to central banks. In the United States, for example, there are a number of different agencies like the FDIC or the Office of the Controller of the Currency that work with the Fed in supervising the financial system. So this is not unique to central banks, and so I'll be downplaying this for the time being and focusing on the two principal tools, monetary policy and lender of last resort activities. Now, where do central banks come from? One thing people don't appreciate, I think, is that central banking is not a new development. It's been around for a very long time. The Swedes set up a central bank in 1668, 3.5 centuries ago. The Bank of England was founded in 1694, and that, of course, for many decades, or if not centuries, was the most important and influential central bank in the world, and France in 1800. So central bank theory and practice is, again, not a new thing. We have been thinking about these issues collectively as an economics profession and in other contexts for many, many years. Now, I've exaggerated slightly in the sense that, say, the Bank of England in 1694 wasn't set up from scratch as a full-fledged central bank. It was originally a private institution. And over time, it acquired some of the functions of a central bank, such as issuing money or serving as lender of last resort. But over time, these central banks became essentially government agencies, government institutions, as they all are today. Certainly, one important responsibility of central banks for much of the period that I'm talking about was to manage the gold standard, to issue paper money that was backed by gold. And I'll talk more about gold in a few moments. Now, the lender of last resort function, which I mentioned earlier, became important in the mostly in the 19th century. Early in the 19th century, the Bank of England was doing a lot of this type of activity, and they became very good at it. And as we'll see, while the United States was suffering with banking panics, in the latter part of the 19th century, banking panics in the United Kingdom were quite rare. So the Bank of England sort of set the pace in some sense. It was the most important central bank, and it helped establish the practices and the approaches that we still use today. Now, I need to talk a little bit, because it's less familiar, about what a financial panic is. In general, a financial panic is sparked by a loss of confidence in an institution. And I think the best way to explain this is to give a familiar example. How many of you have ever seen the movie It's a Wonderful Life? No? Less people are watching Christmas movies than they used to be, I guess. Well, one of the problems that Jimmy Stewart runs into as a banker in Wonderful Life is a threatened run on his institution. And what is a run? Well, let's imagine a situation like Jimmy Stewart's situation before there was any deposit insurance, no FDIC. And imagine you have a bank on the corner, just a regular commercial bank, First Bank of Washington, D.C. And this bank makes loans to businesses and the like, and it finances itself by taking deposits from the public. And deposits are demand deposits, which means that anybody can pull out their money anytime they want, which is important because people use deposits for ordinary activities like shopping. Now, imagine what would happen if, for some reason, a rumor goes around that this bank has made some bad loans and is losing money. Now, as a depositor, you say to yourself, well, I don't know if this rumor is true or not. But what I know is if that I wait and everybody else pulls out their money and I'm the last person in line, I may end up with nothing. So what are you going to do? You're going to go to the bank and say, well, I'm not sure if this is a true rumor or not, but knowing that everybody else is going to come to the bank, I'm going to go pull my money out. And so depositors line up. They pull out their cash. No bank holds cash equal to all their deposits. They put that cash into loans. So the only way the bank can pay off the depositors, once it gets through its minimal cash reserves, is to sell or otherwise dispose of its loans. But it's very hard to sell a commercial loan. It takes time. You have to sell it at a discount. And by the time you've gotten around to doing that, depositors are at your door and saying, where's my money? And so ultimately, a panic can lead the bank to close and be a self-fulfilling prophecy. The bank will fail. It'll have to sell off its assets at a discount price. And ultimately, many depositors might lose money, as happened in the Great Depression, for example. So a bank panic is a problem which is faced by any institution where it has loans or other illiquid type assets, and it finances itself by short-term deposits or other short-term lending. Now, panics can be a serious problem. Obviously, if one bank is having problems, people at the bank next door might begin to worry about problems in their bank. And so a bank run can lead to widespread bank runs or a banking panic more broadly. Sometimes banks, again, pre-FDIC, banks would respond to a panic or a run by refusing to pay out deposits, and they would just say, no more, we're closing the window. So that restriction on the access of depositors to their money was another bad outcome and caused problems for people who had to make a payroll or had to buy their groceries. Many banks would fail. And beyond that, banking panics often spread into other markets. We're often associated with stock market crashes, for example. And all those things together, as you might expect, were bad for the economy. And so a banking panic could lead to a crash in the economy as well. So here's a formal definition, just for your reference. On the left, you see people standing around the corner waiting to take out their money. But a financial panic can occur any time you have an institution that has longer-term illiquid assets. So think of a bank that has loans that are long-term loans that are illiquid in the sense that it takes time and effort to sell those loans, and which are financed on the other side of the balance sheet by short-term liabilities like deposits, but could be other kinds of short-term liabilities. Anytime you have that situation, you have the possibility that the people who put their money in the bank, or the lenders or the depositors, may say, wait a minute, I don't want to leave my money here, I'm pulling it out, and you have a serious problem for the institution. So now to come back to what we were talking about before, how could the Fed have helped Jimmy Stewart? Well, again, lender of last resort is the basic tool. Imagine that Jimmy Stewart is paying out money to his depositors. He's got plenty of good loans, but he can't change those into cash, and he's got people at the door looking for money. Well, if the Federal Reserve was on the job, Jimmy Stewart could call up the local Fed office and say, look, I got a whole bunch of good loans. I can offer them as collateral. Give me cash. Give me a cash loan against this collateral. Okay? So the central bank would act in this way as a lender of last resort. Jimmy Stewart can take the cash from the central bank. He can pay off his depositors. And then, so long as he really is solvent, that is, as long as his loans really are good, the run will be quelled, will be stopped, and the panic will come to an end. So by providing short-term loans, taking as collateral the illiquid assets of the institution, the central bank can put money into the system, pay off depositors, pay off short-term lenders, and calm the situation and end the panic. And this was something that the Bank of England figured out very early. In fact, a very key person in the intellectual development here was a journalist named Walter Bagehot, who thought a lot about central banking policy. And he had a dictum which said that during a panic, central banks should lend freely. Whoever comes to your door, as long as they have collateral, give them money. This is during a banking panic. Against good assets, to make sure that you get your money back, you need to have collateral, and that collateral has to be good, or it has to be discounted, and you could lend half the value of the collateral, for example. And charge a penalty interest rate so that people don't just take advantage of the situation, but rather they signal that they really need the money because they're willing to pay a slightly higher interest rate. So again, if you follow Bagehot's rule, you can stop financial panics. As a bank or other institution finds that it's losing its funding from depositors or other short-term lenders, it borrows from the central bank. The central bank provides cash loans against collateral. The company then pays off its depositors, and again, things calm down. Without that source of funds, without that lender of last resort activity, many institutions would have to close their doors. They could go bankrupt. If they had to sell their assets at discount fire sale prices, that would also create problems because other banks would find the value of their assets had gone down. And so the panic through fear or through rumor or through declining asset values could spread throughout the banking system. So it's very important to get in there aggressively as a central banker, provide that short-term liquidity, and avoid the collapse or at least the serious stress on the system. So again, using the assets as collateral, banks borrow from the central bank. So that's a little bit of general theory about central banks and what they do. Again, their two broad functions are macroeconomic stability and financial stability. And they have tools on both sides of that equation. So let's talk a little bit about specifically the United States and the Federal Reserve. And what we'll find is that the Federal Reserve, which was founded, the law was passed in 1913, it was founded eventually in 1914, we'll find that concerns on both sides of this equation motivated the decision of Congress and President Wilson to create the Federal Reserve. Let's talk first about financial stability in the United States. Now, after the Civil War and into the early 1900s, there was no Federal Reserve, there was no central bank. So any kind of financial stability functions that couldn't be done, say, by the Treasury had to be done privately. And there were some interesting examples of private attempts to create lender of last resort functions. So, for example, a very interesting example is the New York Clearing House. The New York Clearing House was a private institution. It was basically a club of ordinary commercial banks in New York City. And it was called the Clearing House because initially it served as a place where banks could clear checks against each other. They came at the end of each day and they traded, my checks against you and your checks against me, and that was just a way of reducing the cost of managing checking. But as time evolved, clearinghouses began to function a little bit like central banks. So for example, if one bank came under a lot of pressure, the other banks might come together in the clearinghouse and lend money to that bank so it could pay its depositors. And so in that respect, they served as a lender of last resort. Another possibility was sometimes the clearinghouses would all agree that we're just going to shut down the banking system for a week, all banks, and then they would go look at the bank that was in trouble and evaluate its balance sheet and determine whether it was in fact a sound bank. If it was, it would reopen, and normally that would calm things down. So there was some private activity to try to stabilize the banking system. However, in the end, these kinds of private arrangements were just not sufficient. They didn't have sufficient resources. They didn't have the credibility of an independent central bank. After all, people could always wonder whether the banks were acting in other than the public interest, since they were all private institutions. And so it was necessary for the United States to get a lender of last resort that could stop runs on illiquid but still solvent commercial banks. So this is not a hypothetical issue. Financial panics in the United States were a very big problem. So here's the period basically from the restoration of the gold standard after the Civil War in 1879 through the founding of the Federal Reserve. And the graph here shows the number of banks closing during each of the 6 major banking panics that occurred during that time in the United States. And you can see in the very severe financial panic of 1893, more than 500 banks failed across the country. So that was a really big panic and had significant consequences for the financial system and for the economy. Now, 1907 was also a pretty sharp financial crisis. The banks that failed were larger. And it was after that crisis that the Congress began to say, well, wait a minute, maybe we need to do something about this. Maybe we need a central bank, a government agency that can address the problem of financial panics. So that process began. There was a very substantial amount of research done. 23-volume study was prepared for the Congress about central banking practices. And Congress moved deliberatively towards creating a central bank. Before the new central bank was established, though, there was another serious financial panic in 1914. So as you can see, this really was a very serious problem for the U.S. economy. So financial stability concerns were a major reason why Congress decided to try to create a central bank in beginning of the 20th century. But remember, the other major mission of central banks is economic stability, monetary and economic stability. Now, the monetary history of the United States is pretty complicated. Won't try to go through it all. But in the period after the Civil War, until World War I, and then really all the way into the 30s, the United States was on a gold standard. And as you probably know, a gold standard is at least a partial alternative to a central bank. Now, what is a gold standard? What a gold standard is a monetary system in which the value of the currency is fixed in terms of gold. So, for example, by law, in the early 20th century, the price of gold was set at $20.67 an ounce. So there was a fixed relationship between the dollar and a certain weight of gold. And that, in turn, helps set the money supply and helps set the price level in the economy. There were central banks that helped manage the gold standard, but to a significant extent, a true gold standard creates an automatic monetary system. Basically, money is tied to gold. Now, unfortunately, gold standards are far from perfect monetary systems. One small problem, which is not on the slides, but I'll just mention, is that there's an awful big waste of resources. I mean, what you have to do to have a gold standard is you have to go to South Africa someplace and dig up tons of gold and move it to New York and put it in the basement of the Federal Reserve Bank in New York. And that's a lot of effort and work, and Milton Friedman used to emphasize that that was a very serious cost of a gold standard, that all this gold was being dug up and then put back into another hole. So there is some cost to having a gold standard. But there are some other more serious financial and economic concerns that practical experience showed were part of a gold standard. One of them was the effect of the gold standard on the money supply. Since the gold standard determines the money supply, there's not much scope for the central bank to use monetary policy to stabilize the economy. And in particular, under a gold standard, typically the money supply goes up and interest rates go down in periods of strong economic activity. So that's the reverse of what a central bank would normally do today. So again, because you had a gold standard which tied the money supply to gold, there was no flexibility for the central bank to lower interest rates in a recession or raise interest rates in an inflation. Now, some people view that as a benefit of the gold standard, taking away the discretion from central banks, and there's an argument for that. But it did have the implication that there was more volatility year to year in the economy under a gold standard than there has been in modern times. So, for example, movements in output, variability was much greater under the gold standard, and even year-to-year movements in inflation, the volatility was much greater under the gold standard. There were other concerns also with the gold standard. Now, one of the things that a gold standard does is it creates a system of fixed exchange rates between the currencies of countries that are on the gold standard. So, for example, in 1900, the value of a dollar was about $20 per ounce of gold. At the same time, the British set their gold standard as saying roughly 4 British pounds per ounce of gold. So $20 equals 1 ounce of gold, 4 pounds equals 1 ounce of gold, so $20 equals 4 pounds. So what that's saying is basically that a pound is $5. So essentially, if both countries are on the gold standard, the ratio prices between the two exchange rates is fixed. There's no variability, as we see today when the euro can go up and the euro can go down. Now, again, some people would argue that's beneficial, but there is at least one problem, which is that if there are shocks or changes in the money supply in one country, and perhaps even a bad set of policies, other countries that are tied to the currency of that country will also experience some of the effects of that. So I'll give you a modern example. Today, as you probably know, China ties its currency to the dollar. It's become more flexible lately, but for a long time there's been a close relationship between the Chinese currency and the US dollar. Now what that means is that if the Fed lowers interest rates and stimulates the US economy because, say, we're in a recession, that means also that essentially monetary policy becomes easier in China as well, because interest rates have to be the same in different countries with essentially the same currency. And those low interest rates may not be appropriate for China. And as a result, China may experience inflation because it's essentially tied to US monetary policy. So fixed exchange rates between countries tend to transmit both good and bad policies between those countries and take away the independence that individual countries have to manage their own monetary policy. Yet another issue with the gold standard has to do with speculative attack. Now normally, a central bank with a gold standard only keeps a fraction of the gold necessary to back the entire money supply. Indeed, the Bank of England was famous for keeping, as Keynes called it, a thin film of gold. The British central bank only kept a small amount of gold, and they relied on their credibility to stand by the gold standard under all circumstances so that nobody ever challenged them about that issue. But if for whatever reason, if markets lose confidence in your willingness, in your commitment to maintaining that gold standard relationship, you can get a speculative attack. And this is what happened in 1931 to the British. In 1931, for a lot of good reasons, speculators lost confidence that the British pound would stay on gold. So just like a run on a bank, they all brought their pounds to the Bank of England and said, give me gold. And it didn't take very long before the Bank of England was out of gold, because they didn't have all the gold they needed to support the money supply. And then there was essentially, they essentially had to leave the gold standard. So there was a lot of financial volatility created by this attack on the gold standard. There's a story told that a British official, Treasury official, was taking a bath. An aide came running in saying, we're off the gold standard, we're off the gold standard. And he said, I didn't know we could do that. But they could, and they had to. They had no choice, because there was a speculative attack on the pound. Moreover, and related to this, as we saw in the case of the United States, gold standard had plenty of financial panics associated with it. So financial stability was not always assured by the gold standard. And finally, just one last word on the gold standard. One of the strengths that people cite for the gold standard is that it creates a stable value for the currency, creates stable inflation. And that's true over very long periods. But over shorter periods, maybe up to 5 or 10 years, you can actually have a lot of inflation, rising prices, or deflation, falling prices in a gold standard. And the reason is that in a gold standard, the amount of money in the economy varies according to things like gold strikes. So, for example, if in the United States, if gold is discovered in California, and the amount of gold in the economy goes up, that will cause an inflation. Whereas if the economy is growing faster and there's a shortage of gold, that will cause a deflation. So over shorter periods of time, you frequently had both inflations and deflations. Over very long periods of time, decades, prices were quite stable. Now this again was a very significant concern in the United States. Here's a famous figure who you can see was a very good public speaker, William Jennings Bryan, 3-time Democratic candidate for president. In the latter part of the 19th century, there was a shortage of gold relative to economic growth. And since there wasn't enough gold, in some sense, the money supply was shrinking relative to the economy, the U.S. economy was experiencing a deflation. That is, prices were gradually falling over this period. Now, this caused some problems, and the people who were most concerned about it were farmers and other agriculture-related occupations. Think about this for a moment. If you're a farmer in Kansas and you have a mortgage with a bank, and that mortgage requires, say, a fixed payment of $20 each month, that amount of money you have to pay is fixed. But how do you pay that? You pay it by growing your crops and selling the crops in market. Now, if you have a deflation going on, that means that the prices of your corn or your cotton or your grain is falling over time, but your payment to the bank stays the same. So a deflation created a grinding pressure on farmers as they saw the prices of their products going down and as their debt payments remained unchanged. And so farmers were squeezed by this decline in their crop prices, and they recognized that this deflation was not an accident. The deflation was being caused by the gold standard. And so William Jennings Bryan ran for president. His principal platform, principal plank in his platform, was the need to modify the gold standard. In particular, he wanted to add silver to the metallic system so that there would be more money in circulation and more inflation. But he spoke about this in the usual very eloquent way of 19th century orators. He said, "You shall not press down upon the brow of labor this crown of thorns. You shall not crucify mankind upon a cross of gold." And again, what he was trying to say is that the gold standard is killing honest, hard-working farmers who are trying to make their payments to the bank and find the price of their crops going down over time. So the gold standard also created problems and again was a motivation for the founding of the Federal Reserve. In 1913, finally, after all the study, Congress passed the Federal Reserve Act, which established the Federal Reserve, which opened in 1914. There's a picture here which hangs in the Fed of President Woodrow Wilson signing the Federal Reserve Act in 1914. President Wilson viewed this as his primary, most important domestic accomplishment in his term. So again, why did they want a central bank? The Federal Reserve Act called on the newly established Fed to do two things. First, to serve as a lender of last resort and to try to mitigate the panics that banks were experiencing every few years. And secondly, to manage the gold standard, that is to take the sharp edges off the gold standard to avoid sharp swings in interest rates and other macroeconomic variables. So that was the objective of the Federal Reserve. Now, interestingly, the Fed was not the first attempt by Congress to create a central bank. There had been two previous attempts, one of them suggested by Alexander Hamilton and the second somewhat later in the 19th century. In both cases, Congress let the central bank die. And basically the problem was that there was a lot of disagreement between what today we would call Main Street and Wall Street. The folks on Main Street, could include farmers, for example, feared that the central bank would be mainly an instrument of the moneyed interests in New York and Philadelphia and would not represent the entire country, would not be a national central bank. And both the first and the second attempts at creating a central bank failed for that reason. So Woodrow Wilson had, I think, a better idea, and he tried a different approach. And what he did is he created not just a single central bank, say in Washington, but he created 12 Federal Reserve banks located in major cities across the country. And so the picture shows the 12 Federal Reserve districts that we still have today, and each one has a Federal Reserve bank in it. And then a board of governors, which oversees the whole system, is in Washington, D.C. Notice, by the way, how many of the little black dots are to the right. In 1914, most of the economic activity in the United States was in the eastern part of the country. Now, of course, it's much more even, but the reserve banks are in the same locations as they were in 1914. But anyway, the point here, the value of this structure was, again, creating a central bank where everybody, all parts of the country, would have a voice, and where information about all aspects of our national economy would be heard in Washington. And that is, in fact, still the case. When the Fed makes monetary policy, it takes into account the views of the Federal Reserve banks around the country, and therefore we have a national approach to making policy. So the Fed was established in 1914, and for a while life was not too bad. The Roaring 20s, the 1920s, this is called the Charleston, I think. Life magazine, you never heard of that, but it was a very famous magazine for a long time. Anyway, the 1920s, the so-called Roaring 20s, was a period of great prosperity in the United States. The U.S. was absolutely dominant economy in the world at that time because most of Europe was still in ruins from World War I. There were lots of new inventions. People gathered around the radio, and automobiles became much more available. And so there was a lot of new consumer durables and just a lot of economic growth during the 20s. So that was, again, a period of prosperity, particularly in the United States, and the Fed had some time to sort of get its feet wet and establish its procedures. Unfortunately, in 1929, the world was hit by the first great challenge to the Federal Reserve and to also all U.S. economic policymakers, which was the Great Depression. As I'm sure you know, the U.S. stock market crashed in October 29th. What you may not know is that the financial crisis of the Great Depression was not just a U.S. phenomenon, it was global. Large financial institutions collapsed in Europe and other parts of the world. Perhaps the most damaging financial collapse was of a large Austrian bank called the Kreditanstalt that collapsed in 1931 and brought down with it many other banks in Europe. So it was a global phenomenon. And as you know, of course, the economy contracted very sharply, and the Depression lasted for seems like an incredibly long time, from 1929, and it only ended when the United States entered the war after Pearl Harbor in 1941. So here are a few facts about the Depression. I think it's important to understand how deep and severe this episode was. Here's the stock market. You can see the straight line at the left, the vertical line showing October 1929, a very sharp decline in stock prices, unsurprisingly. This was the crash that was made famous by many writers, including John Kenneth Galbraith and others, who told colorful stories about brokers jumping out of windows and all those things. But what I want you to take from this picture is that the crash of '29 was only the first step in what was a much more serious decline. You see how the stock prices kept falling, and by mid-1932, stock prices had fallen an incredible 85% from their peak. So this was much worse than just a couple of bad days in the stock market. The real economy, the non-financial economy, also suffered very greatly. The left-hand picture shows growth in real GDP, and so if the bar is pointing up, it's a growth period. If it's pointing down, it's a contraction period. So in 1929, the economy grew by more than 5%. It was still growing very substantially, but you can see that from 1930 to 1933, the economy contracted by very large amounts every year. So there was an enormous contraction of GDP, close to a third overall, between 1929 and 1933. At the same time, the economy was experiencing deflation. Deflation is falling prices. And as you can see from the right picture, in 1931 and 1932, prices fell by about 10%. So if you were a farmer who had trouble in the late 19th century, imagine what's happening to you in 1932 when crop prices are dropping by half or more, and you still have the same payment to the bank for your mortgage. As the economy contracted, unemployment soared. We did not have the same survey of individual households in the 1930s that we have today, and so these numbers are estimated. They're not precise numbers. But as best we can tell, at its peak, unemployment came close to 25% in the early 1930s. And you can see the light blue line is the recession period. Even at the end of the 30s, before the war changed everything, unemployment was still around 13%. So unemployment rose tremendously. Bank failures, as you might guess, with all that was going wrong in the economy, a lot of depositors ran on their banks. The picture on the right, the graph on the right, shows the number of bank failures in each year. And you can see an enormous spike in the early 30s in number of failures. What caused this colossal calamity, which again I would reiterate was not just a U.S. problem but a global problem? One country, in fact, that had a worse depression than the United States was Germany, and that led probably more or less directly to the election of Hitler in 1933. So what happened? What caused the Great Depression? This is a tremendously important subject and has received a lot of attention, as you might imagine, from economic historians. And as often is the case for very large events, there were many different causes. I mentioned a few here. The repercussions of World War I, problems with the international gold standard, which was being reconstructed, but with a lot of problems after World War I. The famous bubble in stock prices in the late 1920s, and the financial panic that spread through the world. So there were a number of factors that created the Depression. But the one that I want to focus on here, let me say one more word before turning on. Part of the problem was intellectual rather than policy per se. At the time of the 1930s, there was a lot of support for a approach or thinking about the economy called the liquidationist theory. And the idea behind it was the 1920s was too good a time. The economy expanded too fast. There was too much growth. There was too much credit extended. Stock prices went too high. So what you need when you have a period of excess is a period of deflation, a period where all the excesses are squeezed out. So there was a point of view which said that the Depression is unfortunate, but it's kind of necessary. We've got to squeeze out all of the excesses that accumulated in the economy in the 1920s. And there's a famous statement by Andrew Mellon, who was Hoover's Secretary of the Treasury: liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. Sounds pretty heartless, and I think it was, but what he was trying to convey here was that we got to get rid of all the excesses of the 20s and bring the country back to a more fundamental, sound economy. All right, so what I wanted to get into here in the last few minutes is what was the Fed doing during this period? Unfortunately, the Fed met its first great challenge in the Great Depression, and it failed, both on the monetary policy side and on the financial stability side. On the monetary policy side, basic bottom line here is that the Fed did not ease monetary policy the way you would expect it to in a period of deep recession, for a variety of reasons, because it wanted to stop the stock market speculation, because it wanted to maintain the gold standard, because it believed in the liquidationist theory. For a variety of reasons, the Fed did not ease monetary policy, or at least not very much. And so we didn't get the offset to the decline that monetary policy could have provided. And indeed, what we saw was the sharply falling prices. I mean, I think you can argue about causes of the decline in output and employment, but when you see 10% declines in the price level, you know monetary policy is much too tight. So the deflation was, in fact, an important part of the problem because, again, it bankrupted farmers and others who relied on the sale of products to pay fixed debts. To make things even worse, as I mentioned before, if you have a gold standard, then you have fixed exchange rates. So the Fed's policies were essentially transmitted to other countries, which also essentially therefore came under excessively tight monetary policy, and that also contributed to the collapse. Now, again, as I mentioned, one reason why the Fed kept money tight was because it was worried about a speculative attack on the dollar. Remember, in 1931, the British had faced that situation. The Fed was worried that there would be a similar attack that would drive the dollar off gold. So to preserve the gold standard, they raised interest rates rather than lowered them. They argued by keeping interest rates high, that would make U.S. investments attractive and prevent money from flowing out of the United States. But again, that was the wrong thing to do relative to what the economy needed. In 1933, Franklin Roosevelt abandoned the gold standard, and suddenly monetary policy became much less tight, and there was a very powerful rebound in the economy in 33-34. The other part of the Fed's responsibilities, of course, is to be lender of last resort. And once again, the Fed did not meet its mandate. They responded inadequately to the bank runs, allowing essentially this tremendous decline in the banking system as many banks failed. And as a result, bank failures swept the country. As I mentioned before, a very large fraction of the nation's banks failed. Almost 10,000 banks failed in the 30s. And that continued until deposit insurance was created in 1934. Now, why did the Fed not more aggressively be lender of last resort? Why didn't it lend to these failing banks? Well, in some cases, the banks were really insolvent. There wasn't much could be done. They had made loans in agricultural areas, and their loans were all going bad because of the crisis in the agricultural sector. But part of it was the Fed appeared, at least to some extent, to agree with the liquidationist theory, which said that there's too much credit, we're overbanked, let the system contract. That's really the healthy thing. But that was unfortunately not the right prescription. Now, of course, in 1933, Franklin Roosevelt came into power. Roosevelt had a mandate to do something about the Depression. He took a variety of different actions. He was very experimental. Some of those actions were quite unsuccessful. For example, something called the National Recovery Act tried to fight deflation by requiring firms to keep their prices high. But that wasn't going to help without a bigger money supply. So a lot of things that Roosevelt didn't work so well, but he did two things which I would argue did a lot to offset the mistakes, the problems that the Fed created. The first was, in 1934, the establishment of deposit insurance in the FDIC. Now, if you were a ordinary depositor in a bank and the bank failed, you still got your money back, and therefore there was no incentive to run on the banks. And in fact, once the deposit insurance was established, we went from literally thousands of bank failures to zero. It was an incredibly effective policy. The other thing that FDR did, although he threw up a lot of smoke while he was doing it, but basically he abandoned the gold standard. And by abandoning the gold standard, he allowed monetary policy to be released and allowed expansion of the money supply, which ended the deflation and led to a powerful short-term rebound in 33 and 34. So the two most successful things that Roosevelt did were essentially offsetting the problems that the Fed created, or at least exacerbated by not fulfilling its responsibilities. So what are the policy lessons? It was a global depression, had many causes. The whole story requires you to look at the whole international system. But policy errors in the United States, as well as abroad, did play an important role. And in particular, as I said, the Federal Reserve failed in this first challenge in both parts of its mission. It did not use monetary policy aggressively to prevent deflation and the collapse in the economy, so it failed in its economic stability function. And it didn't adequately perform its function as lender of last resort, allowing many bank failures and a resulting contraction in credit and also in the money supply. So in that respect, again, the Fed did not fulfill its intended mission. So these are key lessons. We'll want to keep these in mind as we consider how the Fed responded to the 2008-2009 financial crisis, which we'll be getting to the beginning of next time, and then in great detail next week. So next time, on Thursday, we'll review developments in central banking after World War II, but we'll spend plenty of time next time in the lead up to the crisis of 2008-2009, and we'll begin to see how the history of central banking explains how the Federal Reserve responded to this most recent and severe crisis. Okay, I'd be happy now to take questions on the lecture. Yeah, Michael.
You mentioned the tightening of monetary policy in 1928 and 1929 to stem the stock market speculation. Do you think that the Federal Reserve should have taken different actions to stem the speculation, like increasing margin requirements, or was it wrong for them to take any action at all against the bubble?
Well, that's a good question. What the Fed did, well, I think the mistake they made, they were very concerned about the stock market, and they believed that it was excessively priced, and there was evidence for that. But what they did was they attacked it solely by raising interest rates without attention to the effect on the economy. So by raising interest rates, they wanted to bring down the stock market, and they succeeded, of course. But the side effect of it was it also had major impacts on the economy as well. So I think that what we've learned about asset price bubbles, they are dangerous, and we want to address them if possible. But where you can address them through financial regulatory approaches, that's usually a more pinpoint approach than just raising interest rates for everything. So margin requirements, or at least looking at the variety of practices. You know, there were a lot of very risky practices by brokers. You know, it was the equivalent of day traders. You know, every paper boy had a tip for you, and there weren't very many checks and balances on trading and on who could make a trade and what margin requirements were, et cetera. So it's a good question. I think that the first line of attack should have been more focused on bank lending, on financial regulation, and on the functioning of the exchanges. Wade, come take the...
I have a question on the gold standard. Given everything that we know about monetary policy now and about the modern economy, why is there still an argument, some argument, for returning to the gold standard, and is it even possible?
So the argument, I think, has two parts. One is the desire to maintain, quote, the value of the dollar. I mean, basically, it's a desire to have very long-run price stability. So the argument is that paper money is inherently inflationary, so if you have a gold standard, you won't have inflation. And as I said, that's true to some extent over long periods of time. But from a year-to-year basis, it's not true. And so looking at history is helpful there. The other reason I think that gold standard advocates want to see return to gold is that it removes discretion. It doesn't allow the central bank to respond with monetary policy, for example, to booms and busts. And the advocates of the gold standard say it's better not to give that flexibility to the central bank. So those are basically the arguments. I think, though, that the gold standard would not be feasible for both practical reasons and policy reasons. On the practical side, there's just a simple fact that there's not enough gold to meet the needs of a global gold standard. And achieving that much gold would be very expensive, cost a lot of resources. But more fundamentally than that is that the world has changed. So the reason the Bank of England could maintain the gold standard, even though it had very small amount of gold reserves, was that everybody knew that they were going to, their first, second, third, and fourth priority was staying on gold, and that they had no interest in any other policy objective. But once there was concern that Bank of England might not be fully committed, then there was a speculative attack that drove them off gold. Now, economic historians argue that after World War I, the labor movements became much stronger, and there was a lot more concern about unemployment. Before the 19th century, people didn't even measure unemployment. And after the World War I, you began to get much more attention to unemployment and business cycles. So in a modern world, the commitment to the gold standard would mean that we are swearing that under no circumstances, no matter how bad unemployment gets, are we going to do anything about it using monetary policy. And if investors had 1% doubt that we would follow that promise, then they would have every incentive to bring their cash and take out gold, and in fact, it would be a self-fulfilling prophecy. And we've seen that problem with various kinds of fixed exchange rates that have come under attack during financial crises. So I understand the impulse, but I think if you look at actual history, you'll see that the gold standard didn't work that well, and it worked particularly poorly after World War I. Indeed, well, I won't go into it, there's a good bit of evidence that the gold standard was one of the main reasons that the Depression was so deep and long. And a striking fact is that countries that left the gold standard early and gave themselves flexibility on monetary policy recovered much more quickly than the countries that stayed on gold to the bitter end.
You mentioned that President Roosevelt used deposit insurance to help end the runs, and also abandoning the gold standard to help end deflation. And I believe that in 1936 and 1937, up until 1941, we had a double dip, and the recession sort of went on. And as you've seen today, that we're sort of out of the recession. What do you think are things that we need to be careful of that possibly they had mistakenly done in the Great Depression that we, in parallel, should be doing today?
Right. It isn't generally appreciated. The Great Depression actually was two recessions. There was a very sharp recession in 29-33. From 33 to 37, there was actually a decent amount of growth. Stock market recovered some. But in 37-38, there was a second recession that wasn't quite as serious as the first one, but still serious. And there's a lot of, I don't want to, it'd take a while to go through all the discussion there, but there's a lot of controversy about it. But one view that was advanced early on was that the second recession came from a premature tightening of monetary and fiscal policy. So in 37-38, there was Roosevelt, under a lot of pressure to reduce budget deficits and so on, tightened fiscal policy quite a bit. The Fed, worried about inflation, tightened monetary policy. Now again, as I don't want to claim it's all that simple. A lot was happening. But the early interpretations, at least, were that the reversal in policy too soon prevented the recovery from proceeding faster. I think we'll talk about lessons later on, but I think if you accept that traditional interpretation, it is that you need to be attentive to where the economy is and not move too quickly to reverse the policies that are helping the recovery. Leland.
Yes, based on a few of the graphs that we saw today and other historical trends, it seems that after an economic slump, recovery often takes 5 or more years, as represented by the Great Depression and the oil crises in the 70s. I was wondering, do you think it is common for unemployment to remain at high levels until sometimes a half-decade after an economic slump, and that criticisms are often premature? And moreover, how do you address these concerns in a political environment when short-term fixes are often rule the day?
Well, let me just comment that the Depression was a sort of extraordinary event. I mean, there were many serious declines in economic activity in the 19th century, but nothing quite as deep or quite as long as the Great Depression. So the high unemployment that lasted from 1929 until basically World War II, that was unusual. So we wouldn't conclude that that was a normal state of affairs. Now, more generally, there is some research that suggests that following a financial crisis, it may take longer for the economy to recover because you need to restore the health of the financial system. And that may be one reason, so argued, that the recovery, this most recent recovery, is not proceeding faster than it is. But that's, I think, it's still an open question, and there's a lot of discussion about that research, as well as discussion of what might underlie that sort of stylized fact that is out there. So no, it's not always the case. I mean, if you look at recessions in the post-war period in the United States, you see very frequently that recoveries only take a couple of years. But in fact, very sharp recoveries, recessions are typically followed by a faster recovery. That's been the pattern in the post-war period. What may be different about this episode, and again, once more, this is a subject of debate, is that unlike the other recessions in the post-war period, this one was related to and triggered by a global financial crisis. And so it may be that it's going to take longer, it's already taking longer for the economy to recover. But again, a lot of issues still to be resolved. Last question. Anyone else? Melanie.
Since you said depression was global recessions are global, shouldn't there, you feel like, be more global cooperation and the central banks to have a uniform type of fix they kind of coordinate on instead of every country determining their own fixes?
Well, you set me up perfectly for my lecture next week, but I'll talk about how the Fed and other central banks did cooperate and continue to cooperate. One of the problems in the Depression was the bad feelings left over from World War I. In the 19th century, there was a reasonable amount of cooperation among central banks, but in the 1920s, Germany was having to pay reparations. France and England and the U.S. were all bickering about war debts. And so the politics was quite bad internationally, and that impeded some of the cooperation of central banks. The other thing to say is that international central bank cooperation is probably even more important when you have fixed exchange rates. So you had fixed exchange rates in the 20s because of the gold standard. That meant that monetary policy in one country affected everybody. So that was certainly a case for more coordination. Didn't get it. At least today, we have flexible exchange rates which can adjust and tend to insulate other countries from the effects of monetary policy in a given country. And so that reduces somewhat the need for coordination, but there's still, I think, a need for coordination. Well, thanks. This has been great, and I'll be back on Thursday. Thank you.
Well, we're just about out of time at 2 o'clock. And I told my friends at the Fed as we were setting this up, we thought that we might have 10, 15 minutes for a question and answer after the chairman left. I said, this is an old professor. I mean, once he gets up there, he's going to have a good time, and we're going to have Q&A that's going to go on for a while, and I'm delighted with that. Students, great questions, wonderful questions. What I would like to ask you to do, since we didn't have a lot of time for additional one, is to send me an email with 2 additional questions that you want to do follow-up on in 2 weeks. We will see you this Thursday at 12:45. Great. Thank you very much.
Thank you very much.
I think it's safe to move now. Okay, let's go ahead and get started. I would like to welcome the students back for our second lecture today, as well as our faculty. I know we have some new guests and friends that are here today. You are in for a treat. If it's anything like it was Tuesday, this will be another great session. Without further ado, Chairman Bernanke.
Thank you very much. You came back. That's good news. As you know, today is the second of 4 lectures on the financial crisis in the Federal Reserve. As I said, I think it's very helpful to try to put the recent crisis and the ongoing recovery into an historical context. And so last time we talked about the origins of central banking, going back to Bank of England and the debates of the 19th century, the origins of the Federal Reserve, and the Federal Reserve's first great challenge, which was the Great Depression of the 1930s. And we drew some lessons from the 1930s that will come back and be relevant as we discuss more recent events. Today, I'm going to pick up the history after World War II, talking about some important episodes after the war. But I will be getting in today to the beginnings of the crisis. And so the latter part of today's lecture and all of next week will be about the crisis. Now, as we go along, I just want to make sure you keep your eye on the ball. Thematically speaking, the 2 basic ideas, the 2 basic missions of a central bank are, first, macroeconomic stability, maintaining stable growth and keeping inflation low and stable. And of course, as you know, the principal policy tool for maintaining macroeconomic stability is monetary policy. In normal times, the Fed or other central banks will use open market operations, purchases and sales of securities in markets to move interest rates up or down, and in doing so try to create a more stable macroeconomic environment. So that's an important part of any central bank's mission. The other part of its mission, though, is financial stability. Central banks are focused on trying to ensure that the financial system is functioning properly, and in particular they want to prevent, if possible, and if not, to mitigate the effects of a financial crisis or financial panic. And we talked last time about the lender of last resort function, the notion that in a financial panic, a central bank can follow Bagehot's rule of lending freely against good collateral at a penalty rate, and that by providing short-term credit to financial institutions, a central bank can offset the effects of a run or a panic and the accompanying damage to the financial system and the economy. But let's move ahead and talk a little bit about the history. We left off at World War II, which ended the Depression, which led to a sharp drop in unemployment as people were put to work building munitions and serving the home front. Now, one of the aspects of wars that economists pay attention to is how wars get financed. And normally wars are financed very substantially by borrowing. And this was not a surprise. U.S. national debt was built up quite substantially during World War II to pay for the war. And the Fed, in cooperation with the Treasury, used its ability to manage interest rates to keep interest rates low so as to make it cheaper for the government to finance World War II. So that was the role of the Fed during the war. Now, after the war ended, the debt was still there. The government was still worried about paying the interest on the national debt, which was at a very high level. And so there was considerable pressure on the Fed to keep interest rates low, even after the war. But there was a drawback to that, which is that if you keep interest rates low, even as an economy is growing and recovering, you're risking an overheating economy, you're risking inflation. So by 1951, the Fed was very concerned about inflation prospects in the United States. And after a series of complex negotiations, the Treasury agreed to end the arrangement and let the Fed set interest rates independently as needed to achieve economic stability. And that agreement was called the Fed-Treasury Accord of 1951. And it was very important because it was the first clear acknowledgement by the government that the Federal Reserve should be allowed to operate on an independent basis. And today, around the world, there's a very strong consensus that central banks that operate independently will deliver better results than those which are dominated by the government. In particular, a central bank which is independent can ignore short-term political pressures, for example, to pump up the economy before an election. And in doing so, it can take a much longer perspective and get better results. And the evidence for this is quite strong. And as a result, major central banks around the world are typically independent, which means that they make their decisions irrespective of short-term political pressures. Now, in the 1950s and the 1960s, the primary concern of the Fed was macroeconomic stability. You see a picture there of the chairman, William McChesney Martin. He was chairman from 1951 to 1970, 19 years. He was the leader of the Fed. Chairman Greenspan's term ended at 18 years, 6 months. He unfortunately didn't break the record. I know he was very disappointed about that. But in that case, we had two Federal Reserve chairmen who between them accounted for more than 37 years of leadership at the Fed during the post-war period. Now, Monetary policy during the 50s and early 60s was relatively simple. The economy was growing. Again, as after World War I, after World War II, the U.S. economy was dominant. The fears about a renewed depression had not come true, and as a result, a lot of growth was occurring. What the Fed tried to do basically was follow what's called a lean against the wind monetary policy, which means that when the economy is growing quickly, or perhaps too quickly, the Fed tightens to try to restrain overheating. And when the economy is growing more slowly, the Fed lowers interest rates, creates some expansionary stimulus in order to avoid a recession. William Chesney Martin was very attentive to the risks of inflation. He's having a quote there from him: "Inflation is a thief in the night." And he tried, through this lean against the wind policy, to keep inflation and growth stable. And indeed, despite the fact that the 50s were perhaps more tumultuous than you might think, there was, after all, a serious war in Korea. There were a couple of recessions during that decade. Nevertheless, it was basically a productive and prosperous decade as the economy went back to civilian operations after the end of World War II. However, as usual, things were not to remain completely trouble-free. Starting in the mid-1960s, for a variety of reasons which I'll talk about, monetary policy became too easy. And after a period of time, and given the Fed didn't change its policy stance, this easy monetary policy led to a surge in inflation and inflation expectations. And on the right, you see a graph of inflation. You can see from 1960 to 64, inflation averaged only a little over 1% a year. It picked up during the Vietnam period, 65 to 69, even higher in the early 70s. But by the end of the 70s, the CPI inflation rate peaked at about 13%. So you can see inflation was a growing problem starting in the mid-60s and into the 70s. So an important question is, why was monetary policy so easy as to allow inflation to become a problem in the 70s? Well, one issue was really a technical issue, which was that monetary policymakers became too optimistic about how hot the economy could run without generating inflation pressures. There was a general view that unemployment could be kept at the low level, like 3 or 4%, and by keeping inflation a little bit higher, you would be able to get that better performance, that higher employment level. And again, in the prosperity of the 50s and the early 60s, the Fed began to follow that approach. There was actually quite a subtle issue here, which was that economic theory and practice in the 50s and early 60s suggested that there was a permanent trade-off between inflation and employment. The notion being that if we could just keep inflation a little bit above normal, that we could get permanent increases in employment, permanent reductions in unemployment. And that was the view that was taken by many economists during that time. It was actually Milton Friedman, the famous monetary economist, who wrote in the mid-60s, quite prophetically, that this was going to cause trouble. And he argued that increase in inflation may give you a little bit of a bump up in employment, might cause unemployment to fall for a while, but at best that's going to be a transitory effect. The analogy might be to a candy bar. If you take a candy bar in the short run, it gives you a little bit of a burst of energy, but after a while it just makes you fat. So monetary policy was analogous to that. And Friedman argued, and he turned out to be quite prescient, that attempts to keep unemployment too low through monetary policy were going to end up creating inflation. So that doctrinal issue was one reason why monetary policy was too easy. There are also debates still today about whether or not there were political pressures put on the Fed. After all, this was a period of, again, of government deficits as the government was trying to deal with Vietnam, was trying to deal with the Great Society. And that may have also influenced the Fed's behavior. Now, the Fed, obviously, you can't have sustained inflation without monetary policy being too easy. Another famous quote from Milton Friedman is that inflation is always and everywhere a monetary phenomenon. Nevertheless, there were a bunch of exacerbating factors that made the problem worse and made it more difficult for the Fed to offset the increase in inflation. First, there were a number of shocks to the prices of oil and food. A very striking example was in 1973. In October of 1973, the Yom Kippur War in the Middle East broke out. In retaliation to U.S. support of Israel, the OPEC, the Organization of Petroleum Exporting Countries, found some cartel power, put an embargo on oil exports, and in a short period of time, in the early 1970s, the price of oil almost quadrupled. So a very sharp increase in oil prices and thus in gas prices. People were lining up at gas stations to make sure their gas tanks were full. There was a system of even-odd rationing. If your license plate was even, you could only go on Tuesdays and Thursdays to the gas station. If it was odd, you could go on Mondays and Wednesdays. So it was a very serious issue, and there's a lot of unhappiness, obviously, about gas prices then, as there is, of course, today as well. Fiscal policy, I also mentioned. Fiscal policy was overall too loose during the late 60s and early 70s. The Vietnam War and other government programs increased government spending and increased deficits, which put additional pressure on the capacity of the economy. Now, another element that I just mentioned briefly is wage price controls. When inflation got up to about 5% in the early 70s, President Nixon introduced wage price controls, that is a series of laws which forbade firms from raising their prices. There were exceptions, and there were boards that tried to find exceptions, and it was basically a very unsuccessful policy. On the one hand, as you know, prices are the thermostat of an economy. They are the mechanism by which an economy functions. So putting controls on wages and prices meant that there were shortages and all kinds of other problems throughout the economy. But in addition, again, as Milton Friedman put it, this was like dealing with a overheating furnace by breaking the thermostat. I mean, the fundamental problem was the fact that there was too much aggregate demand driving up prices, and simply passing a law which says people couldn't raise prices doesn't address the underlying problem of excessive monetary ease and excessive demand. So the wage price controls kept inflation artificially low for a couple of years, made it harder for the Fed to figure out what was going on. And when the wage price controls finally collapsed in disarray because they were creating so many problems in the economy, inflation surged as like a spring that was released at the end of the wage price controls. So there were a lot of reasons supporting the increase in inflation. I think a general lesson, here's a picture of Arthur Burns, who was the chairman of the Fed during the 1970s. And the quote is, "In a rapidly changing world, the opportunities for making mistakes are legion," which is certainly true. I think one way to think about this whole episode is that after World War II and the end and the conquest of the Depression and the prosperity that they saw, economists and policymakers became a little bit too confident about their ability to keep the economy on an even keel. And there was the term fine-tuning, the notion that the Fed and other fiscal policy and other government policies could keep the economy more or less perfectly on course and not worry about bumps and wiggles in the economy. Now that turned out to be too optimistic, too hubristic, and we learned that collectively during the 70s when the efforts of policymakers resulted not in the lower unemployment rate, which was the original goal, but instead a higher and very sharp increase in inflation. So I think one of the themes here is that, and this probably applies in any complex endeavor, that a little humility never hurts. Now, there was a reaction to the increase in inflation in the 70s. And the key person in this period is Chairman Paul Volcker, who remains to this day an influential figure in economic policy discussions. To deal with double-digit inflation, I should say first that President Carter, whose re-election was under serious threat by the poor performance of the U.S. economy, appointed Paul Volcker to be the new chairman of the Fed. And in part he did so because President Carter thought that Volcker was a tough central banker who would do what was necessary to get inflation under control. And Paul Volcker, who stands 6'8" and smokes a big cigar, was certainly created a impression of somebody who's willing to take strong action. And perhaps it wasn't a total coincidence. So Paul Volcker came into office. He was only in office for a few months when he determined that strong action was needed to address the inflation problem. And in October of '79, he and the Federal Open Market Committee, the policy-making committee of the Fed, instituted a strong break in the way that monetary policy was managed. It's not really necessary to go into the details of what that break was and how it worked. Basically, what it did was allow the Fed to raise interest rates quite sharply. And again, as you know, raising interest rates slows the economy and brings inflation pressures down. As Paul Volcker said, to break the inflation cycle, we must have credible and disciplined monetary policy. And it worked. In the years after this program began, inflation fell quite sharply. You can see from 1980 to 1983, inflation fell from about 12 or 13% all the way down to about 3%. So a relatively quick decline in inflation that offset the problems of the late 70s. So in that respect, the policies of the 80s were quite successful. They achieved their objective of bringing inflation under control. However, nothing is free, and one of the effects of these policies was to raise interest rates quite sharply. I do remember vaguely I just got out of graduate school about 81, 82, and I do remember looking at the possibility of buying a home and being informed that the mortgage rate for a 30-year mortgage was 18.5%. So interest rates were quite high, and as you might expect, that brought down economic activity and affected inflation as well. So if you look at the graph, you see this is the unemployment rate. The high interest rates, which were necessary to bring down inflation, also caused a very sharp recession. And in fact, the unemployment rate in 1982 was almost 11%, even higher than we saw in the most recent recession. So there was definitely a very negative side effect from Volcker's activities. Now, I think an interesting aspect of this is that the political pressure, as you can imagine, on the Fed and on Chairman Volcker was intense. During this period, it was a common practice to mail to the Fed bits of 2x4s. And on the 2x4s it would say, "Stop killing construction," or "Save the farmer," or whatever it might be, because the high interest rates were having very negative effects on the economy. And I have a few of these on my desk just to remind that inflation is a concern and that we always have to pay attention to price stability. But this is also an example of why independence is important. If Paul Volcker had been to be reelected, perhaps he wouldn't have been able to sustain this policy. But instead, he maintained an independent monetary policy. He received at least sufficient support from President Reagan and from the Congress. And he was able to carry through the policy, which, again, succeeded in bringing inflation down. Now, during the 70s, obviously, output and inflation were very volatile. We saw how much inflation moved around. We saw that there was, I didn't mention, but there was a pretty sharp recession also in 1973 to 75 after the OPEC embargo. And then, of course, there was more volatility in the early 80s as Volcker brought down inflation and as the economy went into recession. Now, Paul Volcker left the chairmanship in 1987, and he was replaced by Alan Greenspan, who, again, held the position for almost 19 years, from 87. As the quote suggests, one of the important accomplishments of Greenspan through most of his tenure was achieving greater economic stability. As he says, greater economic stability has been key to impressive growth in standards of living in the United States. So, in fact, there was so much improvement in the stability of the economy that the period has come to be known as the Great Moderation, as opposed to the Great Stagflation of the 70s or the Great Depression of the 30s. Now, this was a very real and striking phenomenon, the Great Moderation. The first picture here shows you the variability of real GDP growth. So the graph covers the period from 1950 all the way up essentially to the present. The line just shows you quarterly growth rates in GDP. So a sharp line, a sharp peak shows an increase in GDP growth. A negative decline shows a fall in GDP growth. These are quarterly numbers. And so you can see the bounciness, you know, periods of growth followed by periods of slower growth. The yellow bar is a one standard deviation band. Essentially, it's a measure of the average volatility of GDP growth quarter to quarter during the period between 1950 and 1986, or 85, I guess. And you can see that GDP growth was pretty variable throughout the entire period. There's a lot of volatility in the economy. There were a number of recessions, including the severe ones in 73 and 81. Now, amazingly, starting from about 1986, look at what happens to GDP variability between 1986 and 2007 or so. The variability from quarter to quarter is much less. And the blue line shows the average variability, a one standard deviation band, for GDP growth in this latter period. And it's just very striking how much more stable the economy was over this 20 or so year period. This was true not only for real GDP growth, it was also true for inflation. So again, it's the same picture basically. The line, the vertical line in the middle of the graph splits the time period from pre-1986 and post-1986. The graph shows inflation quarter by quarter as measured by the Consumer Price Index. Again, the tan bar shows one standard deviation average volatility of inflation in the pre-1986 period. You can see the huge spikes in inflation in the 70s. And then in post-86, you see much more stable, much lower volatility. So both growth and inflation were much more stable and are really quite remarkable to a quite remarkable extent, and something that economists commented on quite frequently. So that was so-called Great Moderation. Now, why? Why was the economy so much more stable between the mid-'80s and the mid-2000s? Well, there's lots of research on it, a lot of issues, a lot of papers. I think there's a good bit of evidence that monetary policy played a role in creating better stability. In particular, Volcker's contribution was, even though his short-term efforts to bring down inflation in the early 80s led to a high recession, led to a lot of pain, there was a payoff, and that payoff was an economy which was much more stable, with low, stable inflation, more stable monetary policy, more confidence on the part of business people and households, and that contributed very importantly to broader stability. So you remember that the Friedman pointed out that there was no long-term trade-off between inflation and unemployment. By keeping inflation a little higher, you couldn't permanently lower unemployment. But in a different sense, which is true, but in a different sense, low and stable inflation over a long period of time does make an economy more stable and supports healthy growth in productivity and economic activity. So low inflation is obviously a very good thing to have, and the reduction in inflation that occurred in the 80s was really a global phenomenon. A lot of countries had inflation problems in the 80s, but all around the world, even developing countries brought down their inflation rates quite considerably, and that has been a positive for economic growth and stability since the mid-80s. Now, not all of the great moderation was caused by monetary policy. There are other factors, no doubt, playing a role. I mentioned just general structural change in the economy. An example would be that over time, firms have learned how to manage their inventories much more effectively. The practice of so-called just-in-time inventory management is a practice whereby instead of having large stocks of inventories on hand, firms only acquire inputs when they need them to produce. And without large stocks of inventories in hand, that reduces an important source of fluctuations in the economy, because if demand slows down and you have a big inventory, then you don't do any more production for quite a while until you run down that inventory. But improved management of inventories is just an example, and many others could be cited, of better business practices and other factors in the economy that made things more stable. And it may also just be the case that there was better luck, that we had fewer oil price shocks and other things happening, and that too may have contributed to the Great Moderation. But as those previous pictures showed, I hope it's clear that it was quite a striking change in the way the economy operated after the mid-80s. Okay, now this takes us up then into the mid-2000s, and so now finally we can begin to talk about financial stress and recent developments. Now, just a final word about the Great Moderation. One of the other aspects of that period is that there weren't any big damaging financial crises in the United States. There was a stock market crash in 1987, but it didn't do much damage. A more significant event was the boom and bust in the dot-com stocks in the late 90s, and that touched off a mild recession in 2001. But one of the inferences that people took away from the Great Moderation was not only was the economy more stable, but the financial system seemed more stable as well. And as a result, financial stability policies got de-emphasized to some extent during this period. Well, let's turn now finally to the prelude to the financial crisis. And what I'll do today is just talk about some of the initiating, triggering events, particularly the housing bubble. And again, as I said, we'll get next week into more details about what happened during the crisis and the Federal Reserve's response. One of the key events that led ultimately to the recent crisis was a big increase in house prices. So the graph on the right shows prices of existing single-family homes where January 2000 is indexed to be 100. From the late 1990s until early 2006, house prices across the country increased by about 130%. You can see that line going straight up, a very sharp increase in home prices. And as I'll discuss, at the same time that was happening, or perhaps a little bit later in the process, the lending standards for new mortgages to buy homes were deteriorating. Now, clearly, a big part of what was happening to create the housing bubble or the increase in housing prices was psychology. After all, the late 90s was a period, as you know, again, of a lot of optimism about tech stocks and stock market more generally. And some of that optimism, some of that psychology, no doubt, fed over into the housing market. So there was an increasing sense that house prices would keep rising, and that housing was a can't-lose investment. I lived in California for a while, and earlier than this, but it was a period during which house prices were rising, and all everybody ever talked about at cocktail parties was, what's your house price now, and how much money are you making on your home, and it kind of made working kind of unnecessary because all you had to do was keep checking the real estate listings. So there was a lot of excitement and enthusiasm about the fact that house prices were going up and making everybody rich. At the same time that this was happening, the standards for underwriting new mortgages were getting worse and worse, which in turn was bringing more and more people into the housing market and pushing up prices even further. So let's talk a bit about mortgage quality and what happened. Prior to the early 2000s, home buyers were typically asked to make a significant down payment, 10%, 15%, maybe 20% of the home price. And of course, they had to document their finances, their income, their assets, and so on in great detail to persuade the bank to make them a loan, which in many cases might be 4 or 5 times their annual salary. Unfortunately, as house prices rose, many lenders began to offer mortgages to less qualified borrowers, so-called non-prime mortgages. And these mortgages often required little or no down payment and little or no documentation. Now, I say non-prime instead of subprime. Subprime mortgages were the lowest quality mortgages in terms of the credit of the borrowers. But there were other mortgages that were below so-called prime mortgages, so-called Alt-A and other types of mortgages that were also not up to the traditional standards of credit underwriting. So I say non-prime. What was happening again was that essentially that mortgage lenders were moving further down the credit spectrum, lending to more and more people whose credit was less stellar. You can see this in a number of different ways. On the left side of this picture is the percentage of mortgage originations, that is, new mortgages created that were non-prime, that is, either subprime or Alt-A or some other lower quality mortgage. And you can see the very sharp increase, particularly in the middle of the 2000s. In 2006, almost a third of all mortgages that were originated were non-prime. Another indicator of the deterioration of mortgage quality on the right figure is the percent of non-prime loans with low or no documentation. Now, if you think about this, this is kind of perverse. If you're going to make a loan to somebody whose credit is shaky, who doesn't have a down payment, and maybe their FICO score is low and so on, you think you would want to ask them even more questions about their income and their prospects. But in fact, it went the other way, and you can see that by 2007, 60% of non-prime loans had little or no documentation to describe the creditworthiness of the borrower. So there was clearly an ongoing deterioration of mortgage quality. Now, this situation couldn't go on forever. This picture shows the this picture shows the debt service ratio. As house prices went up and up and up, the amount of income or the share of income being spent on your monthly mortgage payment went up. And as you can see, eventually the mortgage payments became quite a large share of personal disposable income, finally reaching the point that the cost of home ownership was high enough that it began finally to dampen the demand for new houses. And as we see, that service ratio collapsed going after that, basically because interest rates came down. But the main point here is that high payments on mortgages finally meant that there were no longer new borrowers, new home purchasers, and so house prices burst, the bubble burst. Here's a picture of home prices. You can see again the sharp increase from the late 90s up until about 2006. But from 2006 until today, house prices have fallen more than 30%. So there's been a very sharp decline in home prices across the country. Now, one comment about this picture. If you look at this picture, you might say to yourself, oh my gosh, we have a long way to go. Because as you can see, house prices today are still a good bit above where they were 15 years ago. But remember, these prices are in dollar or nominal terms. There's no adjustment for inflation. So even if there was just 2% inflation a year, over a period of 15 years, that would raise prices by 30 or 40%. So if you adjust this for inflation, you get that house prices now are coming much closer to where they were before the beginning of the bubble. Now, the house price collapse had some significant consequences. One consequence is that many people who had felt rich because their home values had gone up and they had a lot of equity, suddenly they found themselves underwater, which means that their mortgage, the amount of money they owed, was greater than the value of their home. So this is a negative equity. So this is an upside-down situation where the borrower is, in fact, has negative wealth or negative equity in the home. And you can see that starting in 2007, the number of mortgages that were in negative equity grew very sharply. Currently, there are about 12 or 13 million mortgages out of a total of about 55 million or so in the United States. So roughly 20 to 25% of all mortgages are now currently underwater. So that's a very big change from the situation we saw before. At the same time, given the decline in house prices, given the fact that a lot of people borrowed more than they could afford, the decline in house prices also led to a big increase in mortgage delinquencies, people not paying on time, and ultimately the bank taking over the property, and that's called a foreclosure, and then reselling the property to somebody else. So this is mortgage delinquencies. And you can see that in 2009 there were more than 5 million mortgages in delinquency, which is about, again, almost 10% of all mortgages. So a very, very high rate of delinquencies. Now, of course, what we just looked at was the effects of the house price bust on the borrowers and on the homeowners, and those are quite serious. But of course, there's another side to this, which is the lenders, the people who made the loans. And obviously, with something close to 10% of mortgages in delinquency, banks and other holders of mortgage-related securities suffered sizable losses, and that proved to be an important trigger of the crisis. Now, there's an interesting question here. In 99, 2000, 2001, we had a big increase in stock prices, including but not only dot-com or tech bubble prices, and those prices fell very sharply in 2000, 2001, and a lot of paper wealth was destroyed by that. And in fact, the amount of paper wealth destroyed by the decline in dot-com and other stock prices was not radically different from the amount of wealth destroyed by the housing boom and bust. And yet, as you know, the dot-com bust led only to a mild recession. The 2001 recession went from, I believe, March to November of 2001. It was only an 8-month recession. Unemployment rose, but it was not anything nearly so dramatic as in the 80s or more recently. And so here we had a big boom and bust in an asset price, but without too much real serious or lasting damage to the financial system or the economy. Now, in the recent case, we had a housing boom and bust. if we were looking back at 2001, we would think that, well, that's going to cause a slowdown in the economy, but probably it won't be that serious. And that was one of the views that we were discussing in the Fed in 2006 as we saw house prices decline. Might this be more like the 2001 episode than something different? And yet, of course, as we know, the decline in house prices had a much bigger impact on the financial system and the economy than the decline in stock prices. And I think to understand that, it's important to make the distinction between triggers and vulnerabilities. The decline in house prices and the mortgage losses were a trigger. Use another metaphor, it was a match thrown on kindling. But there would not have been a conflagration unless there was a lot of dry tinder around. And in this case, there were vulnerabilities in the economy and the financial system that the housing bust, in some sense, set afire. In other words, there were weaknesses in the financial system that transformed what might otherwise have been a modest recession into a much more severe crisis. Now, what were those vulnerabilities? What was it about the financial system of the United States and of other countries as well that transformed the housing boom and bust into, again, a much more serious crisis? Again, we'll talk about this in much more detail next week, but just to preview, there were vulnerabilities in both the private sector of our financial system and also in the public sector. On the private sector, many borrowers and lenders took on too much debt, too much leverage. And one reason they might have done that is because of the Great Moderation. There was 20 years of relatively calm economic and financial conditions, and people became more confident, more willing to take on more debt. The problem with taking on too much debt is that if you don't have much margin, if the value of your asset goes down, like your value of your house, then pretty soon you find that you have an asset which is worth less than the amount of money you borrowed. A second problem, a very important problem, was that throughout this period, financial contracts, financial transactions were becoming more and more complex in ways which I'll describe. But the ability of banks and other financial institutions to monitor and measure and manage those risks was not keeping up. That is, their IT systems, their resources they devoted to risk management were insufficient for them to understand fully what risks they were actually taking and how big the risks were. So if you had asked a bank in 2006, well, suppose house prices fall 20%, they probably would have greatly underestimated the impact of that on their balance sheet because they didn't have the capacity to measure accurately or completely the risks that they were facing. The third problem, which I'll come back to again, is the funding side. Financial firms in a variety of contexts relied very heavily on short-term funding like commercial paper, which can have a duration as short as 1 day, or most of it is less than 90 days. So like the banks in the 19th century that were relying on deposits and making loans, they had essentially on the liability side of their balance sheet, they had a very short-term liquid form of liability, which, as we'll see, was subject to runs in the same way that deposits were subject to runs in the 19th century. A final private sector vulnerability was the use of exotic financial instruments, complex derivatives, and so on. An example of this was the credit default swaps employed by the AIG Financial Products company. AIG used the credit default swaps essentially to sell insurance to investors on the complex financial instruments that the investors held. So basically what AIG was promising was that if you lose any money on these collateralized debt obligations or whatever these things are, we'll make good. As long as the economy was doing well and the financial system was doing well, then they were just collecting the premiums on this insurance essentially, and there was no problem. But once things went bad, their being on one side of all these bets meant that they were exposed to enormous losses, which had, as we'll see, very serious consequences. So those are some of the problems that occurred on in the private sector. Let me talk a little bit about the public sector. There were also serious problems there as well. First, the financial regulatory structure had been changed, of course, a number of times. Basically, it was the same structure that had been created in the 1930s after, during the Depression. And in particular, it didn't keep up with all kinds of changes in the structure of the financial system. One aspect of that was that there were many important financial firms that didn't really have any serious comprehensive supervision by any financial regulator. So an example of this was AIG, which was an insurance company. The insurance regulators looked primarily at the insurance products they sold. The Office of Thrift Supervision looked at primarily at the thrift, the small bank that they owned. But nobody was really looking carefully at this CDS problem that I was just describing. Another category of firms that didn't have much oversight were investment banks, like Lehman Brothers and Bear Stearns and Merrill Lynch. There was no statutory oversight of those firms. They had a voluntary agreement with the SEC for oversight, but there really was not comprehensive oversight of those firms. And as I'll talk about, another group of firms was the government-sponsored enterprises, Fannie and Freddie, which did have supervisors, did have regulators, but for reasons I'll explain, was very, very inadequate. So the regulatory structure had lots of holes in it, and there were many important firms that proved important during the crisis that didn't have good oversight. There were also, even where the laws provided for regulation and supervision, it often wasn't done as well as it should have been. And while this was true across a whole range of agencies and parts of the government, since I'm the Fed chairman, let me talk about the Fed. The Fed made mistakes in supervision and regulation. I think two I would point out. One would be in our supervision of banks and bank holding companies. We didn't press hard enough on this issue of measuring your risks. I mentioned before that a lot of banks simply didn't have the capacity to thoroughly understand the risks that they were taking. The supervisors should have pressed them harder to develop that capacity, and if they didn't develop that capacity, should have restricted their ability to take these risky positions. I think the Fed and other bank supervisors didn't press hard enough on this, and that turned out to be obviously a serious problem. Another area where the Fed, I think, performed poorly was in consumer protection. The Fed had some authorities to provide some protections to mortgage borrowers that would have, if used effectively, would have reduced at least some of the bad lending that occurred during the latter part of the housing bubble. But for a variety of reasons, that wasn't done not nearly to the extent it should have been. In 2007, when I became chairman, we did undertake some of these protections, but that was obviously too late to avoid the crisis. So where there were authorities and powers, they weren't always effectively used, and that obviously led to some weaknesses. And then a final, and perhaps more subtle point, the way our regulatory system is set up, individual agencies like the Fed or like the OCC or the Office of Thrift Supervision typically had as their responsibility just a specific set of firms. So the Office of Thrift Supervision was only responsible for thrifts and similar institutions. Unfortunately, the problems that arose during the crisis were much broader based than that. They transcended any single firm or small group of firms. They transcended the whole system. And so essentially what was missing here was attention, enough attention being paid to things that could affect the system as a whole, as opposed to just individual firms. And so nobody was really in charge of looking to see whether there were problems related to the overall financial system or the relationship between different markets and different firms that could create stress or even a crisis. So those were some of the vulnerabilities in the public sector. And we're going to come back to these vulnerabilities and how they played out next week. Let me conclude here by talking about a controversial topic, which is another aspect, which is the role of monetary policy. Now, many people have argued that another contributor to the housing bubble was the fact that the Fed kept interest rates low in the early part of the 2000s following the recession of 2001. So when the economy got very weak and there was very slow job growth in 2001 and subsequently, and when inflation fell very low, the Fed cut interest rates, and in 2003 the federal funds rate got down to 1%. And there are people who argue that this was one of the reasons that house prices went up as much as they did. And in fact, it is true that low interest rates, one of the purposes of low interest rates that the monetary policy achieves is to increase the demand for housing and thereby to strengthen the economy. Now, as I say, this is very controversial, but it's also very important, not only because we want to understand the crisis, but because going forward, we want to think about, what should we take into account when we look at monetary policy? To what extent should we be thinking about things like housing bubbles when we make monetary policy? Now, we've looked at this in great detail inside the Fed, and there's been a lot of research outside the Fed, and let me just warn you that there's no consensus on this, and you'll probably hear different points of view, but the evidence that I've seen and that we've done within the Fed suggests that monetary policy did not play an important role in raising house prices during the upswing. And let me just talk a little bit about some of the evidence on this question. One piece of evidence is the international comparison. People don't appreciate that the United States, the boom and bust in the United States was not unique. Many, many countries around the world had booms and busts in house prices. And those booms and busts were not very closely related to the monetary policies of those particular countries. For example, the United Kingdom had a house price boom that was as big or bigger than that in the United States, but monetary policy was much tighter in the UK than it was in the United States. And so there's a bit of a puzzle for the monetary theory of the house boom. Another example, which is not on the slide, as you know, Germany and Spain both share the euro, so they have the same central bank, the European Central Bank, the same monetary policy. Germany's house prices remained absolutely flat throughout the entire crisis. Spain had an enormous house price increase, considerably larger than that in the United States. So the cross-national evidence raises at least some concerns. The second issue is the size of the bubble. It's true that changes in interest rates and mortgage rates should affect house prices and demand for homes, as I said. And there is a lot of history, a lot of evidence to look at that over a long period of time. But when you look at how much interest rates changed, including mortgage rates, and how much house prices moved, based on historical relationships, you can only explain a very, very small part of the increase in house prices. In other words, the increase in house prices was way too large to be explained by the relatively small change in interest rates associated with monetary policy in the early part of the 2000s. The final piece of evidence I would raise is the timing of the bubble. Robert Shiller, an economist who is well known for his work on bubbles, including the housing bubble, argued that the housing bubble began in 1998, which of course is well before the 2001 recession and before the cut in Federal Reserve interest rates. Moreover, house prices rose very sharply after the tightening began in 2004. So the timing doesn't line up particularly well. Now, what the timing does suggest might be a couple of other possible explanations. One is, obviously 98 was right in the middle of the tech bubble, the tech boom, and it could be that, again, the same psychological optimism, the same mentality that was feeding stock prices may have been feeding house prices as well. Another possibility is that that's been pointed out by a number of economists is that in the late 90s, there was a very serious financial crisis called the Asian financial crisis that hit a number of Asian countries and other emerging market economies as well. And after that crisis was tamed, one response was that many countries, emerging market countries, began to accumulate large amounts of reserves, which meant they had to acquire safe dollar assets. So there was a big increase in the demand for assets, including mortgages, that came from abroad as countries decided they need to acquire more dollar assets to serve as reserves. I think, interestingly, probably the strongest correlation across countries that you can find to house price increases is capital inflows, the amount of money coming in to buy mortgages and other safer, or at least perceived to be safe assets. And that timing would also fit with the 98 or so beginning. So those are some arguments against the view that the monetary policy was a big source, an important source. But I emphasize economists continue to debate this issue, and it's a very important issue. Because going forward, we also have to think about the implications of our low interest rates on the economy and on the financial system. And in particular, currently, just out of caution, we're doing a lot of financial oversight and a lot of regulatory oversight to make sure that, or at least to do the best we can to ensure that nothing is getting unbalanced in the financial system. Here are a few references just to take with you if you want to get into this more. The bottom one is a speech I gave a couple years ago, which summarizes some of the evidence. My speech is based very heavily on the second paper, which is the result of all the internal Federal Reserve research. There's a paper there by Carmen Reinhart and Vincent Reinhart, which makes the point that interest rates didn't move enough to move house prices. And they also make the point about capital inflows. And then Kenneth Kuttner is a recent survey which comes to the conclusion, again, that there was no connection. But again, I emphasize that this is something that continues to be debated. Well, what were the consequences of the crisis? We'll talk more about the crisis next time, but the economic consequences were severe. Here's a measure of financial stress. It's just an index which combines a variety of financial indicators that indicate that the financial system is under great stress, and you can see what happened in 2008, 2009. Sharp increase in financial stress in the financial markets. Stock market plunged. We've been talking about the first decline there, where it says 2000, the 2001 recession. That was the very large decline in tech stocks. But notice the decline in the stock market in the more recent recession was even bigger than the one in 2000, 2001. Here's home construction. You can see the very sharp decline there. Home construction fell before the recession because, of course, it was a trigger of the crisis. But looking to the right, you can see it still hasn't really begun to recover. And then finally, unemployment rose very sharply, peaked around 10%, and has currently fallen down to about 8.3%. So in the next two lectures, we're going to get into the crisis in more detail, talk about how the housing boom and bust and the vulnerabilities in the financial system led to the worst financial crisis, at least since the Great Depression, and possibly even worse than in the Depression, and how the Fed responded to that crisis. And then in lecture 4, we'll talk about the recession recovery and the aftermath, and again, the policy responses there. So that's what I wanted to cover today, and we do have a few minutes, and I'd be happy to take questions. Yeah?
So in the previous...
you might want to take a mic, so...
in the previous lecture, we discussed that the Depression, it seemed that policy was tightened too early, and that led to a double dip. And then today we were discussing that policy in the 70s was too slow to tighten. How do we know when the right time is, and is there a right time, or does it vary all the time?
Well, it's challenging, and that's certainly one of the reasons that we have so many economists and models and everything we can use to try to figure out what the appropriate moment is to tighten or to ease policy. And it's not an easy thing. Forecasting is not very accurate, and so we have to provisionally keep looking at what's happening and making our adjustments as we go along. The 70s was particularly difficult because at that time inflation expectations were not at all tied down. One thing that happened then was that if gas prices went up, then people began to expect higher inflation, and then they began to go and demand higher wages to compensate for the higher prices. But then, of course, higher wages would feed through to higher prices, and so on and so on. And that, in turn, was a result of the fact that everybody expected inflation to go up. Nobody had any confidence that the Fed or the government in general would keep inflation low and stable. Now, a very different situation now, fortunately, and this owes a lot to Paul Volcker and to Chairman Greenspan as well, is that after a long period of low inflation, most people are pretty comfortable that inflation will stay reasonably low, despite the fact that there are ups and downs, with gas prices and so on. And that helps a lot because with inflation staying low, the Fed has more leeway. If policy is easy for a period, that's not necessarily going to feed into a wage price spiral that will create a much bigger inflation problem down the road. So keeping inflation expectations low and stable is in fact one of the great accomplishments of Chairman Volcker and Chairman Greenspan, and an important objective of central banks around the world. So the environment changes over time. It's a difficult task, but the 70s was particularly difficult because at that time, with expectations so volatile, any kind of inflation pressure from gas prices, wherever, quickly fed into wage demands and into other prices. So it was a much more difficult situation. Yeah.
Hi, my name is Jonathan Cohen. So I had a question about the low interest rate monetary policy that you mentioned in the early 2000s, and how your view and the Fed, with all the different research that was conducted, is that it didn't spark the drop in housing that we had. So if, as in your role as Fed chairman, if you were chairman now, do you think that was the right?
I'm chairman now.
Yeah. Sorry. If you were chairman in 2001, would you have kept rates that low? And or if not, do you think it was the correct thing to do? Although it didn't, although you don't think it affected the housing crisis.
The very first, I believe, yes, the very first speech. I was a governor of the Fed during that time. I was on the Fed board during that time, and the very first speech I wrote when I became a governor in 2002. Was about bubbles and financial supervision and regulation. And the theme of my speech was, use the right tool for the job. The problem with tying interest rate policy to perceived bubbles and asset prices is it's like using a sledgehammer to, kill a mosquito. I mean, the problem is housing is only one part of the economy. And interest rates are dedicated to achieving overall economic stability. So we estimate that in order to have stopped the increase in house prices, interest rates would have had to been raised very dramatically in a period where the economy was very weak. Unemployment was still above normal. Inflation was falling down towards zero. And so generally speaking, the right way to use monetary policy is to achieve overall macroeconomic stability. And that doesn't mean you should ignore financial imbalances. And I think what we could have done, the Federal Reserve could have done, would have been to be more aggressive on the supervisory and regulatory side to make sure, for example, that the mortgages that were being made were of better quality and that firms were appropriately monitoring their risks and so on. So I think the first line of defense should be regulation and supervision. Now, I think one of the lessons I talked about today was not to be too sure of anything, to be humble. And for that reason, I think we should never rule out the possibility that if all of our regulatory and other types of interventions don't achieve the stability in the financial system we want, that as a last resort, monetary policy might be modified to some extent to deal with that. But again, because monetary policy is such a blunt tool which affects all asset prices and affects the entire economy, if you can get a focused laser type of tool, that's going to be much better for everybody. Yeah.
At the end of the lecture, you mentioned the role that global imbalances played in fueling the housing bubble. So doesn't the current monetary and fiscal policy that focuses on boosting consumption in the United States from borrowing more, doesn't that kind of lead us down the same road of overconsumption from borrowing that we had that got us into the crisis in the first place?
Well, first of all, we'd like to get a better balance in general. So monetary policy stimulates capital formation as well. It also tends to promote exports. So we would like to get overall, over time, we'd like to get a better balance of consumption, investment, and exports, as well as government spending. Those are the main components of final demand. So monetary policy is consistent with a better balance. But that being said, we are now way below where we were before the crisis. Consumer spending has not recovered. It's still quite weak relative to where it was before the crisis. Private debt has come down quite a bit. And importantly, you mentioned the global imbalances. So we're talking about the current account imbalance or the trade deficit that the U.S. has. It has come down quite significantly. So all those things have moved, if anything, in some sense too far in the short run, because we lack a source of demand to keep the economy growing. Now, again, I agree that just as every country needs to have an appropriate balance of consumption, capital formation, exports, and government spending, and that's an important task for us going forward. But right now, in terms of debt and consumption and so on, we're still, way low relative to the pattern before the crisis.
My name is Alexander Akel, and the latter part of your lecture was about monetary policy in the 2000s after the dot-com bubble and how interest rates were kept low, of course. You argue that that wasn't a trigger to the increase in the increase in house prices, but to look at it from another point of view, what's your take on the argument that the low interest rates cause private investors and banks to make riskier trades because of the low interest rates at the time, and how that could have also been a trigger to the crisis?
Well, that's a good question, and I think there is some effect of low interest rates on risk-taking. But once again, very similar to the previous question, it's an issue of getting the right balance. During a recession, generally speaking, on most dimensions, investors become very cautious. That's certainly where they've been for much of the recent past. And so, again, you want to get an appropriate balance between the amount of risk being taken, not too much, not too little. And but once again, this is yet another reason why financial supervision and regulation needs to be playing a role. Particularly with institutions, large institutions, banks, we need to be looking directly at those firms and making sure that they are managing their risks appropriately. So again, it's a question of what's the right tool for the job. I should go over on this side. Mr. Lippman.
Hi, Daniel Lippman. The slides on the housing bubble show how clearly one thing led to another, rising prices and then eventually a fall. When you were observing the economy in the 2000s, what did you think would happen to the rising house prices and the housing bubble? Did you think that it would eventually lead to a recession? And because I know there's a book called The Big Short where some investors were very prescient in shorting that. What's your take on that?
Well, as I tried to argue, the decline in house prices itself, by itself, was not obviously a major threat. When I was the chief, I was the head of the chairman. I was the chairman of the Council of Economic Advisors for President Bush, and in 2005 we did an analysis for him of what would happen if house prices came down, and what we concluded was, well, we'd have a recession, but we didn't anticipate that the financial crisis, we didn't anticipate that the decline in house prices would have such a broad-based effect on the stability of the financial system. And when I became chairman in 2006, house prices were already declining. And in my 2 weeks after I became chairman, I gave a testimony where I said house prices are falling. That's going to have negative impacts in the economy, and we're not sure of all the consequences and so on. So the fact that house prices might come down, you know, that was always a possibility. The really hard thing, at least in my view, to anticipate fully was that the effects of the decline in house prices would be so much more severe than the sort of similar decline in .com stocks. And again, the reason, as I'll get into more next time, is the ways in which decline in house prices affected mortgages, affected the soundness of the financial system, and created a panic, which in turn led to the instability of the financial system. So it was that whole chain of events that was critical. It was not just decline in house prices, it was the whole chain. Miles?
My name is Miles McGreevy. Amidst the dispersion of cheap credit in the years preceding the housing crisis, there was a bipartisan push for American homeownership, originally spearheaded by President Clinton and later carried on by George W. Bush. To what degree could it be argued that aggressive government policies supporting increased lending during this period contributed to the eventual erosion of credit standards on behalf of the mortgage originators?
That's a very good question. Another controversial question. Certainly there was some pressure to increase home ownership. There was the American dream aspect of owning a home and so on. Home ownership rose during this period. But I think to put it all in the government is probably wrong in this case. Most of the worst loans were made by private sector lenders and then sold to private sector through private sector securitizations. That is, they didn't touch Fannie and Freddie, for example. They went directly to investors. Fannie and Freddie did acquire some subprime mortgages, but actually that was a little bit later in the process rather than at the beginning of the process. So I think there was some of this going on everywhere, but clearly the private sector, you know, without any encouragement from the government, was a big player in the decline in mortgage underwriting and in the selling of packaged mortgages to private investors. Yeah.
So I think one of the hallmarks of the Fed under your leadership has been your commitment to transparency, and I think, you know, we're all benefits of that in the room here. But wondering whether you think perhaps too much transparency could actually damage credibility of a central bank if you sort of get things wrong, I guess.
Okay, so you're a little bit off topic here because we didn't get to transparency today. But just generally, I think I agree. Transparency is very important. It's important for at least a couple of reasons. One is I talked already about the importance of a central bank being independent, so there is one linkage there. But if a central bank is independent and making important decisions which affect everybody, then obviously it's got to be accountable. People have to understand what it's doing, why it's doing it, what's the basis of its decisions. And so for democratic accountability, I think it's important for the central bank to be transparent. And I testify all the time, I give speeches, I have all kinds of town halls and other kinds of meetings like this, and I think it's very important for me at press conferences, I think it's very important for me to explain what we're doing and why we're doing it. So that's one reason for transparency. The other is that over time there's been increased understanding that for most of the time transparency can make monetary policy work better. So for example, if the Federal Reserve communicates that its future actions will be X or Y and conveys that information to the markets may respond to that by building those expectations into interest rates and may have a more powerful effect on the economy. So communication also reduces uncertainty and helps increase the impact of monetary policy in financial markets. I have time only for one more. Yes.
Thank you, Mr. Chairman. My name is Jay Merchandani, and my question is in regards to price stability and inflation expectations. You mentioned the importance of that in macroeconomic stability and long-run economic growth. And given the massive amounts of liquidity that's been pumped in the market recently, how has the Fed been able to maintain inflation expectations so low?
So we're going to have to come back. Let me ask for us to try to stick with the particular topic. On the last day, we'll be talking about current monetary policy. We'll have plenty of opportunities. But let me just
answer it just in the following very brief way, which is that I think we owe something to our predecessors in this respect, Chairman Volcker in particular, and also Chairman Greenspan, got inflation down low and kept it there. And people get used to what they see, right? And in a world in which inflation remains low, year after year, people are going to become more and more confident that the central bank, the Fed, or whoever, will meet its mandate of keeping inflation low. And so it has been very striking that even though we've had movements in oil prices and other shocks to the economy, a deep recession, a financial crisis, everything throughout most of the period, inflation expectations have been very well tied down to about the 2% range that the Fed is trying to hit. Thanks. And next week we'll go into more into the crisis. Thank you very much.
Okay, well, this has certainly exceeded my expectations, and we're grateful that you stayed all the way to 2 o'clock yet again. As with Tuesday, I know that there are still pent-up questions, students, that you have, and so why don't you send 1 or 2 questions to the Blackboard site so we can capture them, so we can talk about them not next week, but the following week when we have our discussions. Have a great weekend, everybody. We will see you next week.
Hello, welcome back. So, Professor Ford says today we want to talk about the Federal Reserve's response to the financial crisis. Now in the last couple of lectures I've mentioned a key theme of the lectures, which is the 2 main responsibilities of central banks: financial stability and economic stability. Let me turn it around just a bit and talk about the 2 main tools. For financial stability, the main tool that central banks have is lender of last resort powers. By providing short-term liquidity to financial institutions, replacing lost funding, central banks, as they have for now a number of centuries, can help calm a financial panic. For economic stability, the principal tool is monetary policy. Of course, in normal times, that involves adjusting the level of short-term interest rates. Now, today I'm going to be focusing primarily on the intense phase of the financial crisis in 2008, 2009, and so I'll be focusing primarily on the lender of last resort function of the central bank. I'll come back to monetary policy in the final lecture when we talk about the aftermath and the recovery. Now, last time, this is just a repeat from last time, I talked about some of the vulnerabilities in the financial system that transformed the decline in housing prices, which by itself seemed no more threatening than the decline in .com stock prices. But because of these vulnerabilities, that decline in housing prices led to, obviously, a very severe crisis. The vulnerabilities I talked about last time were private sector vulnerabilities, including the excessive debt taken on, perhaps because of the period of the Great Moderation. Very importantly, the bank's inability to monitor their own risks. Excessive reliance on short-term funding, which as a bank in the 19th century would tell you, makes it vulnerable to a run as short-term funding is pulled away. And increased use of exotic financial instruments like credit default swaps and others that concentrated risk in particular companies or in particular markets. So that was the private sector. The public sector had its own vulnerabilities, including gaps in the regulatory structure. Important firms and markets did not have adequate oversight. Where there was adequate oversight, at least in law, sometimes the supervisors and regulators didn't do a good enough job. For example, there wasn't enough attention paid to forcing banks to do a better job of monitoring and managing their risks. And finally, an important gap that we've really begun to look at since the crisis is that with individual agencies looking at different parts of the system, there was not enough attention being paid to the stability of the financial system taken as a whole. Let me talk just a moment more about another important public sector vulnerability, and these were the so-called government-sponsored enterprises, Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are nominally private corporations. They have shareholders and a board, but they were established by Congress in support of the housing industry, and they're known as government-sponsored enterprises, or GSEs. Now, Fannie and Freddie, as they're called, don't make mortgages. You can't go to Fannie's headquarters and get a mortgage. What they do instead is they are the middleman, so to speak, between the originator of the mortgage and the ultimate holder of the mortgage. So if you're a bank and you make a mortgage loan, if you like, you can take the mortgage that you made and you can sell it to Fannie or Freddie. They will in turn take all the mortgages that they collect, put them together into mortgage-backed securities, so-called MBS. So a mortgage-backed security is just a security which is a combination of hundreds or thousands of underlying mortgages, and then sell that to the investors. That's a process called securitization, and Fannie and Freddie pioneered this basic approach to getting funding for mortgages. In particular, the GSEs, Fannie and Freddie, when they sell their mortgage-backed securities, they provide guarantees against credit loss. So if mortgages go bad, Fannie and Freddie make the investor whole. Now, Fannie and Freddie were permitted to operate with inadequate capital. So in particular, they were at risk in a bad situation where there were a lot of mortgage losses. They didn't have enough capital to pay off, make good those guarantees that they had promised. And while many aspects of the financial crisis were not well anticipated, this one was. And going back for at least a decade before the crisis, the Fed and many other people, said that the Fannie and Freddie just didn't have enough capital, and that they were, in fact, a danger to the stability of the financial system. What made the situation even somewhat worse was that Fannie and Freddie, besides selling these mortgage-backed securities to investors, they also purchased on their own account large amounts of mortgage-backed securities, both their own and some that were issued by the private sector. So they made profits from holding those mortgages, but again, that created an additional, to the extent that those mortgages were not insured or protected, they were vulnerable to losses, and again, without enough capital, they were at risk. Now, an important trigger, and I'll come back to all these issues, but an important trigger that I talked about a little bit last time, I'm going to say a little bit more about it. Again, it wasn't just a house price boom and bust, but it was the mortgage products and practices that went along with the house price movements that was particularly damaging. There were a lot of exotic mortgages, by which I mean sort of non-standard, standard mortgages, 30-year prime, fixed-rate mortgage. There were all different other kinds of mortgages being offered, and often to people with weaker credit. Now, one feature that many of these mortgages had was that in order for them to be repaid, you had to have ongoing increases in house prices. So, for example, you might be a mortgage borrower who would buy an adjustable rate mortgage, an ARM, where the initial interest rate was, say, 1%, which meant that you could afford the payment for the first year or two. Now, after 2 years, the mortgage might go up to 3%, and after 4 years, 5%, and then higher and higher. So in order to avoid that, you had to, at some point, refinance into a more standard mortgage. And as long as house prices were going up, creating equity for homeowners, then it was possible to do that refinance. But once home prices stopped rising, and by 2006 they were already declining quite sharply, borrowers were finding themselves, rather than building equity, they found themselves underwater. They couldn't refinance, and they found themselves stuck with these increasing payments on their mortgages. Here's some examples of bad mortgage practices. I won't go through all of them, but they all have the characteristic. Take, for example, the second one, an option ARM. That's an adjustable rate mortgage, and the option is the borrower's option to vary how much they pay. They could pay less than the full amount, and what they didn't pay just got rolled back into the mortgage. So most of these mortgages had the feature that they reduced monthly payments, at least early in the mortgage, but allowed mortgage payments to rise over time. The other aspect of bad mortgage practices, like no-doc loans, for example, was that there was very little underwriting, which means very little analysis to make sure that the borrower was creditworthy and was able to make the payments on the mortgage. Here's some advertisements from the period that can illustrate some of the issues. I like the one on the right. We took the name of the company off. But let's look at the features that they're offering here. 1% low start rate. Start rate, that's what you pay the first year. We don't tell you about the next year. Stated income, that means you tell us what your income is, we write it down, that's all the checking we do. No documentation, well that's evident. 100% finance, no down payment in other words. Interest-only loans, which means that you pay the interest, but you don't have to pay any principal back. And debt consolidation, this was an interesting thing, which meant that you could go to the mortgage company and say, well, not only do I want to borrow money to buy the house, but I want to add in all my credit card debt and everything else I owe and put that into one big mortgage payment, and and I'll pay for that with a 1% start rate. So you can see that there are obviously some very problematic practices here. So now the mortgage companies and banks and savings and loans and a variety of other different kinds of institutions made these mortgages, but where did they go? How were they financed? Now some of them were kept on the balance sheet of the mortgage originator, but many or most of these exotic or subprime mortgages were packaged in securities and sold off into the market. So, for example, some of these securities were relatively simple. If the mortgages were sold to Fannie and Freddie, and they had to meet Fannie and Freddie's underwriting standards, Fannie and Freddie would combine them into mortgage-backed securities and sell them with a guarantee, as I described before. And those were relatively simple securities. They're made up of basically just hundreds or thousands of underlying mortgages. But some of the securities that were created were very complex and very hard to understand. An example would be a collateralized debt obligation, or a CDO. This would often be a security that combined mortgages and other kinds of types of debt together in one package, and it could be sliced in different ways so that you would sell to one investor the most safe part of the security and to another investor the most risky part of the security. So they were very complicated, took a lot of analysis. Now one reason that many investors were willing to buy these securities were because they had the comfort of the rating agencies whose job it is to rate the quality of bonds and other securities, giving AAA ratings to many of these securities, essentially saying that they're very, very safe, and therefore you don't have to worry about the credit risk of these securities. So again, many of the securities were sold to investors, including pension funds, insurance companies, foreign banks, even in some cases wealthy individuals, but also the financial institutions that either made these loans or created these securities often retained some of them as well. For example, sometimes they would create an accounting fiction, an off-balance sheet vehicle, which would hold these securities and finance itself by cheap short-term funding like commercial paper. So some of these securities went to investors, some of them stayed with the financial institutions themselves. In addition, we had companies like AIG that were selling insurance. They were using various kinds of credit derivatives to basically say, well, pay us a premium, and if the mortgages in your mortgage-backed security go bad, we'll make you good, we'll make you whole, and that makes it AAA rated. Of course, these practices made the underlying securities no better, and what they basically did was they created a situation where risks could be spread throughout the system. So here's a little bit of a diagram showing how a subprime mortgage securitization might work. On the left, where the box says low quality mortgages, you might have a mortgage company or a thrift company making the loans. The thrift company or the mortgage company doesn't care too much about the quality of the loan because they're going to sell it anyway. So they take the mortgages and they sell them to large financial firms who take those mortgages and maybe other securities as well, combine them into a security which is essentially an amalgamation of all the underlying mortgages and other securities. Now, the financial firm that created the security might negotiate with the credit rating agency to say, well, what do we have to do to get a AAA rating? And there would be negotiations and discussions, and in the end, the security would be rated AAA. The financial firm would then take the security, could cut it up in different ways or just sell it as it is, sell it to investors like a pension fund or some other type of investor. But in addition, again, financial firms kept many of these securities on their own books or in related investment vehicles. And finally, you had over here on the right, you had credit insurers like AIG and other mortgage insurance companies that, for a fee, provided insurance in case the underlying mortgages went bad. So this is kind of the basic structure. In actuality, I've seen some diagrams of the complete flow chart, and they're incredibly complex. This is a very simplified version, but the basic idea is here. Okay, now remember, what is a crisis? A crisis or a financial panic occurs when you have any kind of financial institution. Think of a bank which has illiquid assets like long-term loans, for example, but liquid short-term liabilities like deposits. And in a classic bank panic, if bank depositors lose faith in the quality of the assets held by the bank, they run, pull out their money. The bank can't pay off everybody because they can't change their loans into cash fast enough. And so the run on the bank is self-fulfilling. The bank will either fail or it'll have to dump all of its long-term assets quickly on the market and take big losses. So that's what a panic basically is in the context, say, of a banking system. Well, the crisis of 2008-2009 was basically a classic financial panic, but in a different institutional setting, not in the bank setting, but in a broader financial market setting. So in particular, as house prices fell in 2006 and 2007, for the reasons I described, is when house prices falling, people who had borrowed on a subprime mortgage were not able to make the payments. It was increasingly evident that more and more of them were going to be delinquent or default. And that was going to impose losses on the financial firms, the investment vehicles they created, and also on credit insurers like AIG. Unfortunately, the securities were so complex and the monitoring of the financial firms of their own risks was not sufficiently strong that there was, it wasn't just the losses. I mean, I think a very striking fact is that if you took all the subprime mortgages in the United States and put them all together and assumed they were all worthless, the total losses to the financial system would be about the size of one bad day in the stock market. They just weren't that big. But what was the problem was that they were distributed throughout different securities in different places, and nobody really knew where they were and who was going to bear the losses. So there was a lot of uncertainty created in the financial markets. And as a result, wherever you had short-term funding, whether it was commercial paper or other types of short-term funding, we had all kinds of funding that was not deposit insured. It was so-called wholesale funding. It came from investors and other financial firms. Whenever there was a doubt about a firm, just like in a standard bank run, the investors, the lenders, the counterparties would pull back their money quickly because in the same reason that a depositor would pull their money out of a bank that was thought to be having trouble. So there was a whole series of runs which generated huge pressures on key financial firms as they lost their funding and were forced to sell their assets quickly, and many important financial markets were badly disrupted. Now, in the Depression of the 30s, there were thousands of bank failures, but almost all of the banks that failed in the 30s, at least in the United States, were small banks. And there were some larger banks that failed in Europe. The difference in 2008 was there were many small banks that failed in the United States, but there were also intense pressures on quite a few of the largest financial institutions in the United States. And the next 2 pages are just a short list of some of the firms that came under intense pressure. Bear Stearns, which is a broker-dealer, came under very intense pressure in the short-term funding markets in March of 2008. It was sold to JP Morgan with Fed assistance in March. Things calmed down a bit after that, and over the summer there was some hope that the financial crisis would moderate, but then in the late summer things really began to pick up. In September 7th of 2008, Fannie and Freddie clearly were insolvent. They didn't have enough capital to pay the losses on their mortgage guarantees. The Federal Reserve worked with the Fannie and Freddie's regulator and with the Treasury to determine the size of the shortfall. And over the weekend, the Treasury, with the Fed's assistance, came in and took those firms and put them into a form of limited bankruptcy called conservatorship. And at the same time, the Treasury got authorization from Congress to guarantee all of the Fannie and Freddie obligations. And so if you held a Fannie and Freddie mortgage-backed security, the company itself was now sort of in a partial bankruptcy, but the U.S. government now guaranteed. So that protected those investors. That had to be done, or else there would have been an enormous intensification of the crisis, because investors all over the world held literally hundreds and billions of those securities. Famously, in the middle of September, Lehman Brothers, a broker-dealer, and I'll talk more about this, I have a case study on this coming up, had severe losses. It came under great pressure. It couldn't find either anybody to buy it or to provide capital for it, and so on September 15th, it filed for bankruptcy. On the same day, Merrill Lynch, another big broker-dealer, was acquired by the Bank of America, again, in basically saving the firm from potential collapse. On September 16th, the next day, AIG, with the largest multi-dimensional insurance company in the world, which remember had been selling the credit insurance, came under enormous attack from people demanding cash, either through margin requirements or through short-term funding. The Fed provided emergency liquidity assistance for AIG and prevented the firm from failing. And again, I'll come back to this as well. Washington Mutual was one of the biggest thrift companies, a big provider of subprime mortgages, was closed by regulators later in September. After parts of the company were taken off, J.P. Morgan acquired this company as well. October 3rd, Wachovia, one of the 5 biggest banks in the United States, again came under a serious pressure. It was acquired by Wells Fargo, another large mortgage provider. So this just gives you some sense of, these are some of all these firms I'm talking about were among the top 10 or 15 financial firms in the United States, and similar things were happening in Europe. So this was not a situation where only small banks were being affected. I mean, that was a problem too, of course. But here we had the biggest, largest, most complex international financial institutions at the brink of failure. Now, the lessons from the Great Depression, going back, are 2. First, remember the Fed did not do enough to stabilize the banking system in the 1930s, and so the lesson there is that in a financial panic, the central bank has to lend freely, according to Bagehot's rules, to halt runs and to try to stabilize the financial system. And the second lesson of the Great Depression, the Fed did not do enough to prevent deflation and contraction of the money supply. So the second lesson of the Great Depression is you need to have accommodative monetary policy to help the economy avoid a deep depression. So in heeding those lessons, the Federal Reserve and the federal government did take vigorous actions to stop the financial panic, worked with other agencies, and worked internationally with foreign central banks and governments. Now, one aspect of the crisis that I think maybe doesn't get quite enough attention is the fact that this really was, first of all, a global crisis. In particular, Europe, as well as the U.S., was suffering very severely from the crisis. But it was also a very impressive example of international cooperation. And one particular date that I've singled out here is October 10th, 2008. As it happened, on that day, there was a previously scheduled meeting of the G7 industrial countries that happened to take place here in Washington. The G7 are the 7 largest industrial countries. And the central bank governors and the finance ministers of those 7 countries came and met in Washington. Now, I'll tell you a deep, dark secret, which is that these big, high-profile international meetings are usually a terrible bore, because much of the work is done in advance by the staff, and we have a discussion, but there's a communique which has been written already by the staff, and it's simply fairly routine in most cases. This was not one of those boring meetings. We essentially tore up the agenda, and we sat down and we talked about what are we going to do? How are we going to work together to stop this crisis which was threatening the global financial system? And in the end, we came up with a statement that was written from scratch, based actually on some Fed proposals, and was circulated. And there were a number of principles and statements involved in that. But among those were, first, that we were going to work together to prevent the failure of any more systemically important financial institutions. This was after Lehman Brothers had failed. We were going to make sure that banks and other financial institutions had access to funding from central banks and capital from governments. We were going to work to restore depositor confidence and investor confidence. And then we were going to cooperate as much as possible to normalize credit markets. So this was a global agreement, and subsequent to this agreement, just in the following week, the UK was the first to announce a comprehensive program to stabilize its banking system. The US announced major steps to put capital into our banks, and so on. So a lot really happened in just the next couple of days after this meeting. Now, just to show you that this worked, this shows you, this graph shows you the interest rate charged on loans between banks. This is the interbank interest rate. So if Bank A lends to Bank B overnight, this is the interest rate that was charged. Now, normally the overnight interest rate between banks is extremely low, way less than 1%, because banks, they need some place to park their money overnight, and they have a lot of confidence that it's safe to lend to another large bank overnight. Well, as you can see, starting in 2007, banks lost confidence in each other, and that's shown by the increase in the rates they charge to each other to make loans. So, for example, in 2007, you begin to see the pressures as house prices began to fall, and there were increasing concerns about the quality of the mortgage securities and the quality of the firms. In March of 2008, you can see another little peak there, which is around Bear Stearns, and that was it doesn't look like much, I guess, in comparison, but that was a pretty tough period. It was a period of quite sharp movements in financial markets and in funding markets. Now, look what happened when Bear Stearns happened. There was just an enormous spike in these interbank market rates, and probably not much lending was taking place even at those high rates. What this was indicative of was that suddenly there was no trust whatsoever, even between the largest financial institutions, because nobody knew who was going to be next, who was going to fail, who was going to come under funding pressure. But look what happened after the international announcements. Within a few days, you began to see a reduction in the pressure, and by the end of the year, in early January, there was an enormous improvement in the funding pressures in the banking system. So this, I think, is a great example of international cooperation and illustrates the point that this was not just a U.S. phenomenon, it was not just U.S. policy, it was not just the Federal Reserve, it really was a global cooperative effort, particularly between the United States and Europe. Now, the Fed played an important role, however, in providing liquidity and making sure that the panic was controlled. Let me just talk briefly about this in general, and then I'll do two case studies that will illustrate some of the issues. Now, the Federal Reserve has a facility called the discount window, which it uses routinely to provide short-term funding to banks. Maybe a bank just finds itself short of funding at the end of the day. It wants to borrow overnight. It has collateral with the Fed. Based on that collateral, it can borrow overnight at what's called the discount rate, which is the interest rate that the Fed charges. So the discount window, which allows the Fed to lend to banks, is always there, is always operative. No extraordinary steps were needed to lend to banks. The Fed always lends to banks. We did make some modifications in order to reassure banks about the availability of credit and to get more liquidity into the system. We extended the maturity of discount window loans, which were normally overnight loans. We made them longer term. And we had auctions of discount window funds where firms bid on how much they would pay. And the idea there was by having a fixed amount that we were auctioning, we would at least assure ourselves that we got a lot of cash into the system. Anyway, the point here is that the discount window, which is the Fed's usual lender of last resort facility, lending to banks, was operative, and we used it aggressively to make sure that banks had access to cash to try to calm the panic. But our financial system is a lot more complicated than the one that existed when the Fed was created in 1913. We have many other different kinds of financial institutions and markets now. And as I said, the crisis was like an old-time bank crisis, but it was appearing in all different kinds of firms and different kinds of institutional contexts. So the Fed had to go beyond the discount window. We had to create a whole bunch of other programs, special liquidity and credit facilities, that allowed us to make loans to other kinds of financial institutions, again, on the Bagehot principle that providing liquidity to firms that are suffering from loss of funding is the best way to calm a panic. Now, all these loans were secured by collateral. We weren't taking chances with taxpayer money, and I'll talk about that when we come back. But the cash was going not just to banks, but more broadly into the system. Again, the purpose of this was to enhance the stability of the financial system and get the credit flows moving again. And just to emphasize, this is the traditional lender of last resort function of central banks that has been around for hundreds of years. What was different was that it took place in a different institutional context than just the traditional banking context. Here are some of the institutions and markets that we addressed through our special programs. Banks, of course, were covered by the discount window, but another class of financial institutions, broker-dealers, which are financial firms that deal in securities and derivatives, were also facing very serious problems. That included Bear Stearns and Lehman Brothers, Merrill Lynch, Goldman Sachs, Morgan Stanley, and others. We provided cash or short-term lending to those firms on a collateralized basis as well. As I'll talk about, commercial paper borrowers received assistance, as did money market funds. I'll come back. I'm going to do a little case study on those two. And finally, the asset-backed securities market. In the modern economy, modern financial system, a lot of the funding that you get for not just mortgages, but auto loans, credit cards, all different kinds of consumer credit are funded through the securitization process. That is, a bank might take all of its credit card receivables, bundle them together into a security, and then sell them in the market to investors, much the same way that mortgages were sold. And that's called the asset-backed securities market. The asset-backed securities market pretty much dried up during the crisis, and the Fed created some new liquidity programs to help get it started again, which we were successful in doing. Now, I should mention that while the banks' lending through the discount window was totally standard lending through the normal discount window, these other types of lending required us to invoke emergency authorities. There is a clause in the Federal Reserve Act called 13(3), which says that under unusual and exigent circumstances, basically in an emergency, the Fed can lend to other types of entities other than just banks. And this authority had not been used by the Fed since the 1930s. But in this particular case, with all these other problems emerging in different institutions and different markets, we invoked this authority and used it to help stabilize a variety of different markets. So let me give you just a little bit of a case study here that will help you understand, what we did and how it helped the economy. So I want to talk a little bit here about money market funds. Now, money market funds are basically investment funds in which you can buy shares, and the money market funds take your money and invest it in short-term liquid assets. Money market funds historically have almost always maintained a $1 share price. So they're very much like a bank, actually, and they're used frequently by institutional investors like pension funds. So a pension fund with $30 million in cash probably wouldn't put that into a bank because that much money is not insured. There's a limit to how much deposit insurance covered. So what a pension fund might do instead of putting the cash in a bank would be to put the money into a money market fund which promises $1 for each dollar put in, plus a little bit of interest on top, and invests in very short-term, safe, liquid types assets. And so it's a pretty good way to manage your cash if you're a institutional investor of some kind. So this diagram just shows investors putting their money into money market funds. Now, as I said, money market shares are not insured. They do not have deposit insurance. But the investors who put their money into a money market fund expect that they can take their money out at any time, dollar for dollar. So they treat it like a bank account, basically. The money market funds, in turn, have to invest in something, and they tend to invest in safe short-term assets like commercial paper. Commercial paper is a short-term debt instrument issued typically by corporations, short-term in that it's 90 days or less, typically. A non-financial corporation might issue commercial paper to allow it to manage its cash flows. It might need some short-term money to meet its payroll or to cover its inventories. So ordinary manufacturing companies like GM or Caterpillar would issue commercial paper to get cash to manage their daily operations. Financial corporations, including banks, would also issue commercial paper to get funds that they can then use to manage their liquidity positions, and they can use, again, to make loans to the private economy. So here's the picture a little bit more completely. On the left, again, you see the investor investing their excess cash in a money market fund. The money market fund buys commercial paper, which is basically a funding source for both non-financial businesses like manufacturers and for financial companies who would lend it on to other borrowers. Okay, so now what happened to this very nice arrangement? Well, Lehman Brothers created a huge shockwave, as I'll describe. Lehman Brothers was an investment bank. It was a global financial services firm. It was not a bank, so it was not overseen by the Fed. It was a investment company. It held lots of securities. It did a lot of business in the securities markets. It could not take deposits, not being a bank. Instead, it funded itself in short-term funding markets, including the commercial paper market. Lehman invested heavily in mortgage-related securities and also in commercial real estate during the 2000s. Now, as we know, as house prices fell and delinquencies on mortgages rose, Lehman's financial position got worse, and they were also losing lots of money in their commercial real estate. So Lehman was becoming insolvent. It was losing money in all of its investments, and it was coming under a lot of pressure. And indeed, as Lehman's creditors lost confidence, they started withdrawing funding from Lehman. For example, investors refused to roll over Lehman's commercial paper, and other business partners said, well, we're not going to do business with you anymore because we're afraid you're not going to be here next week. So Lehman was increasingly losing money and increasingly finding itself unable to fund itself. It tried, with Federal Reserve and Treasury help, to either find somebody willing to put more capital into the firm or to acquire the firm. It was unable to do that. So on September 15th, as I mentioned, it filed for bankruptcy. And this was an enormous shock that affected the whole global financial system. Now, in particular, one of the many implications of the failure of Lehman Brothers was in the money market funds. There was one particular fairly large money market fund that held, among its other assets, commercial paper issued by Lehman. And when Lehman failed, that commercial paper was either worthless or at least completely illiquid for a long time. And so suddenly, this money market fund could no longer pay off its depositors at $1 per share. It had lost money. Now, suppose you're an investor in a money market fund, and you know that if you go there and ask for $1 back, you can get it, but you also know that they don't have enough money there to pay everybody off $1. What are you going to do? Same thing that a 19th century bank depositor would do if they heard that their bank had lost money. So investors in this fund and then in other money market funds began to pull out their money just like a standard bank run. And I'll show you the data on that just a second, but we had a very intense bank run, or in this case, a money market fund run, in which investors in these funds began to pull out their money just as quick as they could. Now, the Fed and the Treasury responded very quickly to the situation. The Treasury provided a temporary guarantee, which said that we guarantee that you'll get your money back if you just don't pull it out right now. And the Fed created a backstop liquidity program under which we lent money to banks who in turn used that money to buy some of the assets of the money market funds. And that gave the money market funds the liquidity that they needed to pay off their depositors and help to calm the panic. And just to show you a sense of what was happening here, this is the money outflows from the money market funds. This is a $2 trillion industry. This is daily data. So you see the Lehman bankruptcy. A couple days later, you see the money market fund breaking the buck, which meant that it was unable to pay its investors $1 a share. Following that announcement, you can see that for about 2 days there, about $100 billion a day was flowing out of these funds. Within 2 days, the Treasury announced a guarantee program. The Fed came in to support the liquidity of these funds, and as you can see, the run ended pretty quickly. So, absolutely classic bank run, classic response, providing liquidity to help the institution being run provide the cash to its investors, providing the guarantees, and that successfully ending the run. But that wasn't the end of the story, because remember, the money market funds were also holding commercial paper. And as they began to face runs, they in turn began to dump commercial paper as quickly as they could. And as a result, the commercial paper market went into shock. This is a really nice example of how financial crises can spread in all different directions. So we had Lehman failing. That in turn caused money market funds to experience a run, and that in turn led to a shock in the commercial paper market. So everything is connected to everything else, and it's really hard to try to keep the system stable. So there was, as the money market funds withdrew from the commercial paper market, there was a sharp increase in rates in the commercial paper market, and lenders were unwilling to lend for more than maybe 1 day to commercial paper borrowers, which in turn affected the ability of those companies to function and the ability of those financial institutions to fund themselves. Once again, the Federal Reserve, responding in the way that Bagehot would have had us respond, established special programs. Basically, we stood as backstop lenders. We said, make your loans to these companies, and we'll be here ready to backstop you if there's a problem rolling over these funds. And that restored confidence in the commercial paper market. And there's the picture here. This is commercial paper rates again, and once again you can see the panic phenomenon, a sharp increase in rates, which really understates the pressure, because it doesn't also include the fact that for many companies there was no price at which they could get funding, or if they got funding it was for only overnight or very short-term periods. The Fed's actions restored confidence in that market, and you can see the response. Rates came back down in the beginning of 2009. Okay, one other type of activity, which is the last thing I want to cover. So a lot of what I've been talking about is probably stuff you didn't hear too much about when you're reading the papers. You know, it was working with these critical markets and working with these providing broad-based liquidity to financial institutions to try to bring the panic under control. But we also, the Fed and the Treasury, also got involved in trying to address problems with some individual critical institutions. In March of 2008, as I mentioned before, a Fed loan facilitated the takeover of Bear Stearns by J.P. Morgan Chase, avoiding a failure of that firm. The reason we undertook that action was first that at the time, the financial markets were quite stressed, and we were fearful that the collapse of Bear Stearns would greatly add to that stress and perhaps set off a full-fledged financial panic. Moreover, it was our judgment, at least, that Bear Stearns was solvent. At least J.P. Morgan thought so. They were willing to buy the firm and to guarantee its obligations, so that by lending to Bear Stearns, we were consistent with the proposition that we should be making loans that are likely to be paid back. And we felt that we were well secured in making the loan that we did. In a second example, in October 2008, as I'm sure you all know, AIG was very, very close to failure. This, again, was the largest insurance company, perhaps among the largest in the world. Let me just talk a bit about that case. AIG was a complicated company. It was, on the one hand, a multinational financial services company with many constituent parts, including a number of insurance companies, global insurance companies. But it had a part of the company, which was called AIG Financial Products, that was involved in all kinds of exotic derivatives and other types of financial activities, including, as I mentioned before, the credit insurance that it was selling to the owners of mortgage-backed securities. So when the mortgage-backed securities started going bad, it became evident that AIG was in big trouble, and its counterparties began demanding cash or refusing to fund AIG, and it was coming under tremendous pressure. Now, the failure of AIG, in our estimation, would have been basically the end. It was interacting with so many different firms. It was so interconnected with both the U.S. and the European financial systems, global banks. We were quite concerned that if AIG went bankrupt, that we would not be able to control the crisis any further. Now, fortunately, from the perspective of lender of last resort theory, AIG was taking a lot of losses in its financial products division, but underlying those losses was the world's largest insurance company. So it had lots and lots of perfectly good assets, and as a result, it had collateral which it could offer to the Fed to allow us to make a loan to provide the liquidity it needed to stay afloat. And so to prevent the collapse of AIG, we used AIG assets as collateral and loaned AIG $85 billion. Obviously a fairly serious amount of money. Later, the Treasury provided additional assistance to keep AIG afloat. And again, while it was highly controversial, it was both, we thought, legitimate in terms of lender of last resort theory because it was a collateralized loan and the Fed has in fact been fully paid back. And secondly, because it was a critical element in the global financial system. Over time, as I said, AIG has stabilized. It has repaid the Fed with interest. The Treasury still owns a majority share of its stock, but AIG has been paying back the Treasury as well. It's been in the process of doing that. Now, I'd like to emphasize that what we had to do with Bear Stearns and AIG is obviously not a recipe for future crisis management. This is, first of all, it was a very difficult and in many ways distasteful intervention that we had to do on the grounds that we needed to do that to prevent the system from collapsing. But clearly, it is something fundamentally wrong with a system in which some companies are, quote, too big to fail. If a company is so big that it knows that it's going to get bailed out, even putting aside the fairness of that, it's not at all fair to other companies, but even beyond that, obviously they have an incentive to take big risks. They say, well, we'll take big risks, heads I win, tails you lose. If the risks pay off, we make plenty of money, and if they don't pay off, the government will save us. That's too big to fail, and that's a situation which we cannot tolerate. So, as I'll describe more next time, the problem we had in September of 2008 was we really didn't have any legal tools, policy tools that allowed us to let Lehman Brothers and AIG and these other firms go bankrupt in a way that would not have incredible damage, create incredible damage on the rest of the system. And therefore, we chose the lesser of two evils and prevented AIG from failing. But that being said, going forward, we wanted to be sure that this never happens again. And we want to be sure that the system is changed so that if a large, systemically critical firm like AIG comes under this kind of pressure in the future, that there'll be a safe way to let it fail, so that it can fail and the consequences of its mistakes can be borne by its management and shareholders and creditors. But in doing so, it doesn't bring down the whole financial system. And I'll talk more next time about the progress we've made collectively in instituting a system that will, I hope, eventually at least, end too big to fail. So finally, let me just say a couple words about the consequences of the crisis. We did stop the meltdown. We avoided what would have been, I think, a collapse of the global financial system. That was obviously a good thing. But to give you a sense, one thing that I was always sure of, and I think the Federal Reserve was always sure of, was that collapse of some of these big financial firms was going to have very serious collateral consequences. There were people arguing, even as late as September of 2008, well, why don't you just let the firms collapse? You know, there's not going to, you know, a system can take care of it. Bankruptcy, we have bankruptcy code. Why don't you let them fail? You know, we never thought that that was really a good option. Particularly if the whole system had collapsed, we would have had extraordinarily serious consequences. As it was, even though we prevented the total meltdown, there was still, obviously, as you know, very serious collateral impact on not just the U.S. economy, but the global economy as well. So following the crisis, even though the crisis was brought under control, the U.S. economy and much of the global economy went into a sharp recession. In the United States, GDP fell by more than 5%, which is a quite deep recession. There's some other statistics. 8.5 million people lost their jobs, and unemployment rose to 10%, so very consequential impact. And as I said, this was not just a U.S. situation. The U.S. recession was, in fact, kind of an average recession. There were many countries around the world that had worse declines, particularly those that depended on international trade. So it was a global slowdown. And as all this was happening, fears of a Great Depression, a second 1930s depression, were very real. So nevertheless, the Great Depression was much worse than the recent recession. And I think the view is increasingly gaining acceptance that without the forceful policy response that stabilized the financial system in 2008 and early 2009, we could have had a much worse outcome in the economy. Here's a couple of indicators just to close with a couple of graphs here. So this, I think this is an interesting graph. This shows the stock market. The blue line starts in August 1929, which is the peak of the stock market before the Great Depression. The red line is the more recent stock prices. It starts in October of 2007. Then the graph shows you the evolution of stock prices in the Depression period in the blue and in the more recent period in the red. And the thing which is pretty striking here is that for the first 15 or 16 months, stock prices in the United States behaved pretty much in this crisis as they did in 1929 and 1930. But about 15 or 16 months into the recent crisis, which would have placed it in early 2009, about the time that the financial crisis was stabilizing, look what happened. In the Depression era, the stock prices kept falling, and as I mentioned, in the end, stock prices lost 85% of their value. In the United States, by contrast, stock prices recovered and began a long recovery, and they now are more than double where they were 3 years ago. This is industrial production, a measure of output. Again, the red is the more recent data. The blue is the Depression era data. You can see in this case that the fall in industrial production was not quite as severe, quite as fast as in the Depression, but you get the same basic phenomenon that about 15 or 16 months into the episode, about the time that the financial crisis was brought under control, industrial production bottomed out and began a period of steady recovery, whereas in the Depression, the collapse continued for several more years. Okay, so that is a very rapid overview of the crisis of 08-09. In Lecture 4, we'll talk about the aftermath, the recession. How did monetary policy respond to the recession? Why has the recovery been relatively sluggish? What has happened to financial regulation to try to make sure this never happens again? And what lessons has the Fed taken from this experience? Okay, questions? Yes.
Hello, Chairman Bernanke. My name is Yuki Wu. And in both this class and last class, you mentioned about the increasing insurance of exotic and subprime mortgages. So why do you think these financial institutions are willing to lend such mortgages bear so much risk to even poor credit borrowers? And do you think if they have foreseen the decreased price in the housing market, will they still do the same thing? Thank you.
So there were a couple of reasons. One reason was simply the fact that firms were probably too confident about house price increases. Said, well, house prices are likely to keep rising. And in a world in which house prices are rising, these aren't such bad products because people can afford to pay, you know, for a year, but then they can refinance to something more stable. And this might be a way to get people into housing. But of course, the risk was that house prices wouldn't keep rising, and of course, that's ultimately what happened. The other aspect of this was that the demand for securitized products grew very substantially during this period. In part, there was a large international demand from Europe and from Asia for high-quality assets, and the ever-clever U.S. financial firms figured out that they could take a variety of different kinds of underlying credits, whether it be subprime mortgages or whatever, and through the miracles of financial engineering, they could create from that at least some securities that would be high quality, would be rated AAA, in which they could then sell abroad to other investors. Unfortunately, that sometimes left them with the remaining bad pieces, which they kept or sold to some other financial firm. So there were trends in the financial markets, I think, including overconfidence about their ability to manage those risks, a belief that house prices would probably keep rising, a sense that they could, even after they made those mortgages, they could then sell them off to somebody else, and that other person or other investor would be willing to acquire them. There was a big demand for, quote, safe assets. For all those reasons, it was actually a very profitable activity while it lasted, and only when the house prices began to fall did it become a big loser. Yeah. Yuki, do you have to? Oh, sorry.
Mr. Chairman, my name is Samir Iqbal. You were talking about how one of the major things the Fed had to do was figure out how to get liquidity flowing again in the market. And that kind of reminds me of the Volcker Rule, because as I understand it, the Volcker Rule, of course, bans prop trading by investment banks, but it also leaves gray areas for principal trades, which, as I understand, are very important for market makers to create markets and find liquidity. So I'm wondering what you think about that. Doesn't that seem kind of counterintuitive?
Well, the Volcker Rule is a part of the Dodd-Frank financial regulatory reform that I'll be talking about in more detail on Thursday, and which the Fed and other agencies are tasked with implementing. The purpose of the Volcker Rule, as you said, is to reduce the risk of financial institutions by preventing banks and their affiliates from doing, quote, proprietary trading, which means doing short-term trading on their own account, so from taking those kinds of risks. Now, the law recognizes that there are legitimate exceptions to for why banks might want to acquire short-term securities, and those include, for example, hedging against risk. But one particular exception is to make markets, to serve as intermediaries who buy and sell in order to create liquidity in a particular market. And that's exempted from the Volcker rule, and one of the challenges of implementing this rule is trying to figure out how to set a set of standards that allows the so-called exempted or legitimate activities like market making and hedging while ruling out the proprietary trading. And that's obviously very difficult, and we're working on that. We put out a rule, we've gotten thousands of comments, we're looking at that, trying to figure out how best to do that. But the point you raise is that liquidity in markets is important. During the crisis, it was much worse problem than just a little bit lack of trading volume. You had big financial institutions unable to fund themselves, unable to find the funding to support their asset positions, the assets that they held, which left them with one of two possibilities: either defaulting because they didn't have enough funding, or the tack that many of them took, which was to start selling off assets as quickly as possible, which in turn spread the panic, because if there's a huge seller's market for, say, commercial real estate bonds, that's going to drive the price down very sharply, and then anybody else who was holding those bonds finds their financial position being eroded, and that creates pressure on them. So one of the, I didn't use the word contagion in my discussion. Contagion, just as in a illness context, is the spreading of panic, the spreading of fear from one market, from one institution to another. And contagion was a major problem in many financial panics, but certainly in this one. And that was one of the mechanisms that led the funding pressures to jump from firm to firm and created such a broad-based problem. Daniel, anybody have?
All right, thank you, Mr. Chairman. My name is Daniel Wright, and I had a question specifically. I'm sorry. There we go. My name is Daniel Wright, and I had a question specifically about global collaboration during the financial crisis. You talked about the G7 in 2008, specifically as we saw multinational corporations begin to be on the brink of failure. What pressures came from the international community when the decision to, say, bail out AIG was being debated?
Well, there weren't any real pressures. Everything was happening too fast. I think, in fact, one area where collaboration was not as good as we would like was exactly dealing with some of these multinational firms. For example, there were problems between the UK and US over Lehman Brothers failure, for example, and inconsistencies which caused problems for some of the creditors of Lehman. So one of the things that we're trying to do under the Dodd-Frank financial reform legislation, which includes, as I mentioned before, includes provisions for safely allowing large financial firms to fail. Well, one of the complexities there is that many of the firms that this would be applied to are multinational firms, maybe not just 2 or 3 countries, maybe dozens of countries. And so collaboration with other countries in figuring out how we would work together to help a large multinational firm fail as safely as possible is part of what's going on now as we work internationally. We tried during the crisis to cooperate in a mostly ad hoc way. I mean, we were in touch with regulators in the UK and elsewhere. But given the time frames and the lack of preparation, we didn't do as much as we would be able to do with a lot more lead time. So I think that was a weakness of international collaboration. For the most part, though, countries cooperated in dealing with the financial institutions that were based in their own countries. AIG was an American company, and we dealt with that, whereas a company like Dexia, which was a European company, was dealt with by the Europeans. Also, there was a lot of cooperation between central banks, and I may have a chance to say a bit more about this, but there were a lot of European banks that used dollars, that needed dollar funding as opposed to euro funding. They used dollar funding both because they held dollar assets, they made dollar loans, they made loans to support trade, which is often done in dollars, so they needed dollars. The European Central Bank can't provide dollars, so what we did was what was called a swap, where we gave the European Central Bank dollars, they gave us euros, they took the dollars we gave them and lent them on their own recognizance to European banks, taking off the dollar funding pressure and easing dollar funding pressures around the world. So those swaps, which are still in existence now because of the recent issues in Europe, were an important example of collaboration. We also, in October of 2008, right as this crisis was intensifying, the Federal Reserve and I think 5 other central banks all announced interest rate cuts on the same day. So we coordinated even our monetary policy. So we did our best to coordinate. There were some areas where, like working on multinational firms, where a lot more preparation was needed, and we are still working on those things cooperatively today. Noah.
My name is Noah Wiviet. I was wondering if you could elaborate on the off-balance sheet vehicles that were being used and sort of why they were allowed to, keep that much information off their books.
Well, it has to do with accounting rules, basically. You create this separate vehicle, and the bank might have substantial interest in that vehicle. It might, for example, have a partial ownership. It might have some promises to provide credit support if it goes bad, or liquidity support if it needs cash. But it doesn't have, under the rules that existed at the time, if the amount of control that the bank had on this off-balance sheet vehicle was sufficiently limited, then according to the accounting rules, it could treat it as a separate organization, so to speak, not part of its own balance sheet. And that allowed the banks to get away with somewhat less capital, for example, than they would have had to carry if they'd had all these assets on their own balance sheet. Now, one of the many good developments since the crisis is that these rules have been reworked, and many of the off-balance sheet vehicles that existed during before the crisis would no longer be allowed. They would have to be consolidated, which means they would have to be brought back onto the balance sheet, made part of the bank's balance sheet, have appropriate capital, and so on. So those practices are not completely gone, but the accounting rules have greatly toughened up the situations, circumstances under which a bank can put something off its balance sheet into a separate investment vehicle. Max.
Thank you, Mr. Chairman. You mentioned several large firms that came under pressure in 2008, and also the Fed's doctrine, if you will, of too big to fail. My question was, where do you draw the line between bailing out a bank and allowing it to fail? Is it arbitrary, or is there some sort of methodology that the Fed goes by?
Oh, that's a great question. So first of all, I want to resist that word doctrine a little bit. These firms proved to be too big to fail in the context of a global financial crisis. That was a judgment we made at the time, based on their size, their complexity, their interconnectedness, and so on. It was not something that we ever thought was a good thing. One of the main goals of the financial reform is to get rid of it, because it's bad for the system, it's bad for the firms, it's unfair in many ways, and it would be a great accomplishment to get rid of too big to fail. So it's not something that we advocate or support in any way, and we were just forced into a situation where we were having to choose the least bad of a number of different options. Now, it's a good question. I mean, I think in the case of during the crisis, we basically had to make judgments on a case-by-case basis, and we were trying to be as conservative as possible. I think in the case certainly of AIG, there was really not much doubt in our minds. This was a case where action was necessary if at all possible. Lehman Brothers was in itself probably too big to fail in the sense that its failure had enormous negative impacts on the global financial system, but there we were helpless because it was essentially an insolvent firm. It didn't have enough collateral to borrow from the Fed. We can't put capital into a firm that's insolvent. This was before the TARP or anything else that provided capital that the Treasury could use. So we really just had no legal way to do it. I think if we could have avoided that, we would have done so. It was somewhat ad hoc, I think, although the two cases where we intervened, Bear Stearns and in AIG, I think the case was pretty clear, given not only the firms themselves, but also the context, the environment that was going on at the same time. Now, interestingly, we've had to get much more into this issue since the crisis, because there are a number of different rules and regulations which actually require the Fed and other regulatory agencies to make some determination about how systemically critical a firm is. For example, the new Basel III capital requirements require the largest, most systemically critical firms to have a capital surcharge. They have to hold more capital than firms which aren't as systemically critical. And as part of that process, the international bank regulators have worked together to try and set up a set of criteria relating to size, complexity, interconnectedness, derivatives, a whole bunch of criteria that help determine, how much capital, extra capital they have to hold. Likewise, the Fed now, when it approves a merger of two banks, it has to evaluate whether the merger creates a systemically more dangerous situation. So we have worked hard, and we have put out criteria that describe some of the variety of criteria, including some numerical thresholds that we look at to try to figure out if a merger creates a systemically critical firm, which if it does, we're not supposed to allow that merger to happen. So the science of doing this is progressing. It's still very in its infancy. But again, in the crisis, our actual interventions were limited to, the principal interventions were Bear Stearns and AIG, along with other agencies. We also provided assistance to a couple of other institutions, but nothing nearly to the extent that the AIG situation involved. But we are looking very seriously at this, and indeed, now that the Fed has become much more focused on financial stability, we have a whole division of people working on various metrics, various indicators, both to try to identify risks to the system and also to try to identify firms that need to be, particularly carefully supervised and maybe hold extra capital because of the potential risks that they bring to the system. David.
Thank you, Mr. Chairman. My name is David Pomeroy. One vulnerability that you mentioned was that the credit rating agencies were assigning AAA ratings to securities that carried much more risk than perhaps a AAA rating might warrant. It seems like the incentives would be aligned for the buyers to seek out ratings that were more accurate because they would be taking on more risk. Was there a systemic problem as far as how incentives were aligned within the credit ratings system that allowed these faulty ratings to propagate throughout the system?
Yeah, there were some incentive problems, and you identify one of them, which is that you would think somehow that instead of the seller of the security being the one who hires and pays the credit rater, you would think that it would be in the interest of the buyers, who after all are the ones bearing the risk, to band together somehow and pay the credit rater to give them the best opinion they can about what the credit quality is of the security. Unfortunately, that model doesn't seem to work. There are very few examples of any that I know of where it works, and the problem is what economists call the free rider problem. Basically, if five investors get together and pay Standard & Poor's to rate a particular issuance, unless they can keep that completely secret anybody else can find out, what the rating was, and then they can basically take advantage of that without the having to be part of the consortium that paid. So there have been a lot of ideas out there about how you can restructure the payment system to create better incentives for credit raters. But it is a challenging problem because, again, this obvious, quote, obvious solution of having the investors pay only works if the investors collectively can share the cost and somehow keep that information from being spread among other investors. Okay, 2 o'clock. I'll see you on Thursday to talk about the aftermath of the crisis. Thank you.
The sad thing, of course, about today is it's the last one. And I know that everybody who's been here for the last 2 weeks has really enjoyed this very much, and it has been a terrific experience, a learning experience academically and intellectually, as well as just an experience to be in the midst of this event, which it is, as well as being a class. And so we're looking forward today to the final concluding lecture of the aftermath of the crisis with Chairman Bernanke. Mr. Chairman?
Well, hello again. So today in the final of our 4 lectures, as Professor Ford said, we want to talk about the aftermath of the crisis. Now, just to recap briefly, we talked last time about the most intense phase of the crisis in late '08 and early '09, a financial panic, both in the United States and in other countries, industrial countries, threatened the stability of the entire global financial system. The Federal Reserve, working, as I'll describe, with others, served in its lender of last resort role, provided short-term liquidity to help stabilize key institutions and markets. I think one of the points that we can now draw, having looked at the history, is that rather than being some ad hoc and unprecedented set of actions, that the Fed's response was very much in keeping with the historic role of central banks, which is to provide lender of last resort facilities in order to calm a panic. And what was different about this crisis was that the institutional structure was different. It wasn't banks and depositors. It was broker-dealers and repo markets. It was money market funds and commercial paper, but the basic idea of providing short-term liquidity in order to stem a panic was very much what Bagehot envisioned when he wrote Lombard Street in 1873. Now, I've been focusing very much on the Fed's actions. That's been the topic of the course, of course, but the Fed obviously didn't work alone. We worked in close coordination with both other U.S. authorities and foreign authorities. For example, the Treasury was actively engaged after the Congress approved the so-called TARP legislation. The Treasury was in charge of making sure that banks had sufficient capital, and the U.S. government took an ownership position in many banks that was essentially temporary. Most of those have now been reversed. The FDIC, the Federal Deposit Insurance Corporation, played an important role. In particular, the deposit insurance limits, the $250,000 deposit insurance limits, were raised essentially to infinity for transactions accounts. And the FDIC also provided guarantees to banks who wanted to issue up to 3 years of debt, corporate debt in the marketplace for a fee. The FDIC guaranteed those issuances so that banks could get longer-term funding. So this was a collaborative effort between the Fed and other U.S. agencies. We also worked closely with foreign agencies. I mentioned last time the currency swaps, which are still in existence, whereby the Fed gave dollars to foreign central banks in exchange for their own currencies, and those foreign central banks took the dollars and on their own responsibility, on their own risk, made dollar loans to financial institutions that required dollar funding. We also, of course, continue to be in close touch with finance ministers and regulators around the world as we try to coordinate to deal with the crisis. Now, putting out the most intense phase of the fire was not really enough. There's been a continuing effort to strengthen the financial system, strengthen the banking system. For example, in a quite successful action, one that I think was very constructive, the Fed, working with the other banking agencies, led stress tests of the 19 largest U.S. banks in the spring of 2009. So this was not far after the most intense phase of the crisis. And what we did in an unprecedented way was to disclose to the markets what the financial positions were of the major banks. And those stress tests, which confirmed that our banks could survive even a return to worse economic and financial conditions, created a great deal of confidence in investors and allowed banks to go out and raise private capital, a great deal of private capital, and in many cases to replace the government capital they received during the crisis. The process of stress testing has continued. Just a couple weeks ago, the Fed led another round of stress tests, a very demanding set of stress tests. Our banks did quite well. They've raised a great deal of capital even since 2009. They're in many ways in stronger position than they were even prior to the crisis in terms of capital. So these are steps that are being taken to try to get the banks back into full lending mode. It's still a process in progress, but restoring the integrity and the effectiveness of the financial system is obviously part of getting us back to a more normal economic situation. Now, just saying a few words about the lender of last resort programs. As I've already argued at some length, the programs did appear to be effective. They arrested runs on various types of financial institutions, and they restored financial market functioning. The programs, which were instituted primarily in the fall of '08, were mostly phased out by March of 2010. And they were phased out really in two different ways. First, some of the programs just came to an end. But more often, what happened was that the Fed would, in making loans, liquidity provision to financial institutions, the Fed would charge an interest rate that was lower than the crisis rate, the panic rate, but higher than normal interest rates. And so as the financial system calmed down and rates came down back to more normal levels, it was no longer economically attractive or financially attractive for the institutions to keep borrowing from the Fed, and so the programs just sort of wound down quite naturally. So we didn't have to just shut them down, they just basically disappeared on their own. The financial risks that the Federal Reserve took in these lender of last resort programs were quite minimal. As I've described, the lending was mostly short-term. It was backed by collateral in most cases. In December of 2010, we reported to Congress all the details involved in 21,000 loans that the Fed made during the crisis. Of those 21,000 loans, 0 defaulted. Every single one was paid back. So even though the objective of the program was stabilizing the system, was not profit-making, the taxpayers did come out ahead in those loans. So that was lender of last resort activity. That was the tool, the fire hose, to put out the fire of the financial crisis. But of course, as I described last time, even though the crisis was contained, the impact on the U.S. and global economies was severe, and new actions were needed to help the economy recover. Remembering that the two basic tools of central banks are lender of last resort policy and monetary policy, we now turn to the second tool, monetary policy, which was the primary tool used to try to bring the economy back after the trauma of the financial crisis. Now, you're all familiar with conventional monetary policies. Conventional monetary policies involve management of the short-term overnight interest rate called the federal funds rate.
By raising and lowering the short-term interest rate, the Fed can influence a broader range of interest rates. That in turn affects consumer spending, purchases of homes, capital investment by firms and the like, and that provides demand for the output of the economy and can help stimulate a return to growth. Just a few words on the institutional aspects. Monetary policy is conducted by a committee called the Federal Open Market Committee. The FOMC, as it's called, meets in Washington 8 times a year. During the crisis, it sometimes also held video conferences. When we have a meeting of the FOMC, there are 19 people sitting around the table. There are 7 governors, the 7 members of the Board of Governors who have been appointed by the President and confirmed by the Senate. And then there are the 12 presidents of the 12 reserve banks, each of whom has been appointed by the board of directors of each of the reserve banks and then confirmed by the Board of Governors in Washington. So there are 19 people around the table. We all participate in the monetary policy discussion. And when it comes time to vote, the system is a little bit more complicated. In any given meeting, there are actually only 12 people who are able to vote. The voters at any given meeting are the 7 members of the Board of Governors. Currently 5. We have 2 empty seats, and we hope to get those filled soon. But the 7 members of the Board of Governors have a permanent vote in every meeting. The President of the New York Federal Reserve Bank also has a permanent vote, which goes back, of course, to the beginning of the system and the fact that New York remains the financial capital of the United States. Of the other 11 Reserve Bank presidents, there's a rotation system, and each year 4 of the 11 other Reserve Bank presidents vote, and then at the end of the year they move on to another set. So again, there's a total of 12 votes in any given meeting or any given decision on monetary policy, but the entire group participates in the discussions. Now here's the federal funds rate. Again, the short-term interest rate, that is the normal tool that the Fed uses for monetary policy. You can see that at the end of Chairman Greenspan's term and the beginning of my term in 2006, we were in the process of raising the federal funds rate in an attempt to normalize monetary policy after having easier policy earlier in the decade in order to help the economy recover from the 2001 recession. But in 2007, as the problems began to appear, particularly in the subprime mortgage market, the Fed began to cut interest rates. You can see the right side of the picture as interest rates were sharply reduced. And by December of 2008, the federal funds rate was reduced to a range of between 0 and 25 basis points. A basis point is 1/100th of 1%, so 25 basis points means 1/4 of 1%. So essentially, by December 2008, the federal funds rate was reduced basically to 0. Can't be cut anymore, obviously. So given that as of December 2008, conventional monetary policy was exhausted, we couldn't cut the federal funds rate any further, and yet the economy clearly needed additional support. Into 2009, the economy was still contracting at a rapid rate. We needed to do something else to support recovery, and so we turned to less conventional monetary policy. And the main tool that we've used is what we call within the bounds of the Fed, the large-scale asset purchases, or LSAPs, more popularly known in the press and elsewhere as quantitative easing, or QE. I won't get into why I think LSAPs is a better descriptive name, but in any case, I've had to bow to the common usage. But these large-scale asset purchases, as I'll explain in more detail, were an alternative way of easing monetary policy, again, to provide support to the economy. So how does this work? Well, to influence longer-term rates, the Fed began to undertake large-scale purchases of Treasury and GSE mortgage-related securities. So just to be clear here, the securities that the Fed
has been purchasing are government-guaranteed securities, either Treasury securities, that's the government debt of the United States, or the Fannie and Freddie securities, which recall were guaranteed by the U.S. government after Fannie and Freddie were taken into conservatorship. There have been two major rounds of large-scale asset purchases, one announced in March 2009, often known as QE1, and another announced in November 2010, known as QE2. There have been some additional variations since then, including a program to lengthen the maturity of our existing assets. But these were the two biggest programs in terms of the size and the impact on the balance sheet. And taken together, these actions boosted the Fed's balance sheet by more than $2 trillion. So here's a picture of the asset side of the Fed's balance sheet to help us see the effects of the large-scale asset purchases. The green at the bottom is the traditional securities holdings. So just to be absolutely clear, even under most normal circumstances, the Fed always owns a substantial amount of U.S. Treasuries. We owned about $800 billion plus of U.S. Treasuries before the crisis even began. And so in that respect, it's not like we began buying them from scratch. We've always owned a significant amount of these securities. So the green shows sort of the baseline where we started from. Now, what else appeared on the Fed's balance sheet on the asset side during this period? The dark blue represents assets acquired or loans made during the crisis period. And you can see that in late 2008, our loans outstanding to financial institutions and to some of these other programs rose very sharply. But you can also see that as time passed, and certainly by early 2010, those initiatives to address financial strain had been greatly reduced. If you look at the far right, by the way, you see a little bump there right recently. That's the swaps. We reinstituted and extended the swap agreements with the European Central Bank and other major central banks, and there has been some usage of that in an attempt to try and reduce strains in Europe, and that shows up as a little bump there at the far right of the picture. Now, again, we owned about $800 billion in Treasury securities at the beginning of the crisis, but as you can see from the red, labeled LSAPs, we added about $2 trillion in new securities to the balance sheet during the period starting in early 2009. And then at the top there you have other assets, variety of things, could be security reserves, physical assets, and other miscellaneous items. Now, why were we doing this? Why were we buying these securities? This is, by the way, an approach which monetarists like Milton Friedman and others have talked about. The basic idea is that when you buy Treasuries and GSE securities and bring them onto the balance sheet, that reduces the available supply of those securities in the market. Investors want to hold those securities. In order to be willing to hold a smaller amount, they have to receive a lower yield. Or put another way, if there's a smaller available supply of those securities in the market, they're willing to pay a higher price for those securities, which is the inverse of the yield. So again, by purchasing Treasury securities, bringing them on our balance sheet, reducing the available supply of those Treasuries, we effectively lowered the interest rate on longer-term Treasuries and on GSE securities as well. Moreover, to the extent that investors no longer having available Treasuries and GSE securities to hold in their portfolios, to the extent that they are induced to move to other kinds of securities like corporate bonds, that also raises the prices and lowers the yields on those securities. And so the net effect of these actions was to lower yields across a range of securities. And of course, as usual, lower interest rates have supportive, stimulative effects on the economy. So this was really monetary policy by another name. Instead of focusing on the short-term rate, we were focusing on longer-term rates. But the basic logic of lowering rates to stimulate the economy is really the same. Now, you might ask the question, well, the Fed's going out and buying $2 trillion of securities. How do we pay for that? And the answer is that we paid for those securities by crediting the bank accounts of the people who sold them to us. And those accounts at the banks showed up as reserves that the banks would hold with the Fed. So the Fed is a bank for the banks. Banks can hold deposit accounts with the Fed, essentially, and those are called reserve accounts. And so as the purchases of securities occurred, the way we paid for them was basically by increasing the amount of reserves that banks had in their accounts with the Fed. So you can see this here. This is the liability side of the Fed's balance sheet. Of course, assets and liabilities, including capital, have to be equal. So the liability side had also to rise near $3 trillion, as you can see. Now, take a look first, as you look at this, take a look first at the light blue line at the bottom. The light blue line at the bottom is currency, Federal Reserve notes in circulation. Sometimes you hear that the Fed is printing money in order to pay for the securities we acquire. And I've talked about that in giving some conceptual examples. But as a literal fact, the Fed is not printing money to acquire these securities, and you can see it from the balance sheet here. The light blue line is basically flat. The amount of currency in circulation has not been affected by these activities. What has been affected is the purple area. Those are reserve balances. Those are the accounts that banks, commercial banks, hold with the Fed, and they're assets of the banking system and they're liabilities of the Fed, and that's basically how we pay for those securities. And so the banking system has a large quantity of these reserves, but they are electronic entries at the Fed. They basically just sit there. They're not in circulation. They're not part of any broad measure of the money supply. They're part of what's called the monetary base. But again, they certainly aren't cash. Then there are other liabilities, including Treasury accounts and a variety of other things that the Fed does. We act as the agent, the fiscal agent for the Treasury. But the two main items you can see are the notes in circulation and the reserves held by the banks. So what do the LSAPs or the quantitative easing, what does it do? Well, we anticipated that when we took these actions that we would be able to lower interest rates, and that was generally successful. For example, as you probably know, 30-year mortgage rates have fallen below 4%, which is a historically low level. But other interest rates have fallen as well. Corporate credit has fallen. The rates of interest that corporations have to pay on bonds, for example, have fallen, both because the underlying safe rates have fallen, but also because the spreads between corporate bond rates and Treasury rates have fallen as well, reflecting greater confidence in the financial markets about the economy. And lower long-term rates have, in my view, and I think in terms of the analysis we do at the Fed, have promoted growth and recovery. Although, as I'll talk about, the effect on housing was probably weaker than we had hoped. We've got mortgage rates down very low. You would think that would stimulate housing, but as you probably know, the housing market has not yet recovered. Now, of course, always we have a dual mandate. We always have two objectives. One of them is maximum employment, which we interpret to mean is trying to keep the economy growing and using its full capacity. And low interest rates are a way of stimulating growth and trying to get people back to work. But the other part of our mandate is price stability, low inflation. We've been quite successful in keeping inflation low. It's been helped. I would say that Volcker in particular, and also Greenspan, made it much easier for me because they had already persuaded markets that the Fed was committed to low inflation. And there's a lot of credibility that the Fed has built up over the last 30 years or so. And as a result, markets have been confident that the Fed will keep inflation low, and inflation expectations have stayed low, and except for some swings up and down related to oil prices, overall inflation has been quite low and stable. At the same time, while we've kept inflation low, we've also made sure that inflation hasn't gone negative. Particularly around the time of QE2, November 2010, there was concern that inflation had been falling. It was well below normal levels, and the concern was that we might actually get into a negative inflation or deflation. Those of you familiar with the Japanese situation understand that that's been a big problem for their economy now for quite a few years. We certainly wanted to avoid deflation. I talked about deflation also in the context of the Great Depression. So monetary ease also guarded against the risk of deflation by making sure that the economy didn't get too weak. Now, just one more comment on large-scale asset purchases. A lot of people don't make a very good distinction between monetary and fiscal policy. And of course, I'm sure you understand they're very different tools. Fiscal policy is the spending and taxation tools of the federal government. Monetary policy has to do with the Fed's management of interest rates. These are very different tools. And in particular, when the Fed buys assets as part of a LSAP or QE program, this is not a form of government spending. It doesn't show up as government spending because we're not actually spending money. What we're doing is buying assets which at some point will be sold back to the market, and so the value of that of those purchases will be earned back. In fact, because the Fed gets interest, of course, on the securities that we hold, we actually make a very nice profit on these LSAPs. What we've done over the last 3 years is transfer about $200 billion in profits to the Treasury. That money goes directly to reducing the deficit. So these actions are not deficit increasing. They are, in fact, significantly deficit reducing. All right, so a major tool we used when we ran out of room for short-term interest rates was LSAPs, asset purchases. The other tool that we have used to some extent as well is communication about monetary policy. To the extent that we can clearly communicate what we're trying to achieve, investors can better understand our objectives and our plans, and that can make monetary policy more effective. The Fed has made a lot of steps to become more transparent about monetary policy to try to make sure people understand what we're trying to accomplish. Here's one example. This is a picture of me giving a press conference. So 4 times a year now, after 2-day FOMC meetings, I give a press conference and answer questions about the policy decision. So this is, a new thing for the Fed in terms of trying to explain, what our policies are. Another recent step that we took in terms of communicating our policies more clearly was to put out a statement that described our basic approach to monetary policy, and in particular gave for the first time a numerical definition of price stability. Many central banks around the world already have a numerical definition of price stability, and we, in our statement, said that for our purposes we were going to define price stability as 2% inflation. And so the markets will know that over the medium term, the Fed will try to hit 2% inflation, even as it also tries to hit its objectives for growth and employment. Finally, the Fed has also begun to provide guidance to investors and the public about what we expect to do with the federal funds rate in the future, given how we currently see the economy. So given how we currently see the economy, we tell the markets something about where we think the rates are going to go. To the extent that the market better understands our plans, that's going to help reduce uncertainty in financial markets. And to the extent that our plans are, in some sense, more aggressive than the market anticipated, it will also tend to ease policy conditions. Okay, so again, monetary policy has been used to try to help get the economy back on its feet. The recession, the period of contraction, which was very severe, as of course I mentioned, officially came to an end. There's a committee called the National Bureau of Economic Research, which officially designates the beginning and end dates of recessions. I was a member of that committee before I became a policymaker. And they determined that this recession began in December 2007 and ended in June of 2009. So it was a long recession. When they say the recession ended, what that means basically is not that things are back to normal, it just means that the contraction has stopped and the economy is now growing again. So we've been growing now for almost 3 years, averaging about 2.5% a year. But as I'll describe, we're still some distance from being back to normal. So when you say the economy is no longer in recession, we don't mean that things are great. We just mean that we're no longer actually contracting. We're now growing. So here's a picture of the sluggish economic recovery that we've had. The blue line in the graph shows the path of real GDP. The gray bar shows the period of the official National Bureau of Economic Research recession. You can see it begins in December 2007, and real GDP begins to decline during that period. In mid-2009, the recession is officially over, and you can see since then the blue line's been moving up as the real economy has been expanding. What you can also see, though, is a comparison here. What we did was we said, suppose that the economy had been recovering since mid-2009 at the same average pace as previous recoveries in the post-war period. And that average recovery is shown by the red line. And you can see by comparing that this recovery has been slower than the average recovery in the post-World War II period. It's actually even worse than that in a way, because this was the most severe recession in the post-World War II period, and so you would expect perhaps that recovery might be a little quicker as the economy comes back to its normal levels, but in fact it's been actually slower on average in terms of growth than previous post-war recoveries. Now, a question, and so an implication, of course, of the sluggish recovery is only very slow improvement in the unemployment rate. You can see the unemployment rate rising sharply during the recession period, peaking around 10%, and now coming slowly down to its current value of about 8.3%. That's still quite high, obviously. Here's housing, single-family housing starts. As we discussed in the last lecture and the previous one, housing starts collapsed even before the recession began. Of course, was a trigger of the recession, and you see how very sharply construction declined. But then if you look at the most recent year or two, you see that there have been a few wiggles, but the housing market has not come back. So, this is one reason. If you think, you've asked the question, why has this recovery been more sluggish than normal? One reason certainly is the housing market. In a usual recovery, housing comes back. It's an important part of the recovery process. Construction workers get put back to work. Related industries like furniture and appliances begin to expand. And that's, again, part of the recovery process, but in this case we haven't seen it. Now, why not? Well, there's still a lot of structural factors in the housing market which are preventing a more robust recovery. On the supply side, we still have a very high excess supply of housing, a high vacancy rate. The graph shows you the percentage of housing units in the United States which are vacant. You can see that peaked at over 2.5% during the recession. It's come down some, but it's still well above normal levels. So foreclosed homes, homes where the seller is unable to find a buyer. There are a lot of homes on the market, and that produces excess supply and falling house prices.
On the demand side, you might think that a lot of people would be buying houses these days, because one thing is true about the housing market is that houses are really affordable. Prices are down a lot, mortgage rates are low, and so if you're able to buy a house, you can get an awful lot of house for your monthly payment now compared to where you were a few years ago. But being able to take advantage of that affordability requires, among other things, that you get a mortgage. And this graph shows what's happening in the mortgage market. The lines show the bottom line shows the 10th percentile, the top line the 90th percentile of credit scores of people receiving mortgages. And you can see that before the crisis, people with relatively low credit scores were able to get mortgages. But since the crisis, you can see the whole bottom part of that yellow area has been cut away, implying that people with lower credit scores, and 700 is not a terrible credit score, are unable to get mortgages. And just in general, there's been a much tighter conditions in terms of trying to find a mortgage. So even though housing is very affordable and monthly payments are affordable, a lot of people are unable to get mortgages. So the implications for the economy, with a lot of excess supply in the market, with a lot of people unable to get mortgage credit or afraid to get back into the housing market, house prices have been declining, as shown by the picture on the right. Recently we've seen some leveling out, some flattening out, but so far not much evidence of a pickup. Declining house prices means it's not profitable to build new houses, and so construction has been quite weak. And more broadly, existing homeowners, when they see their house prices down, may mean they can't get a home equity line of credit. It may mean that they just feel poorer. And so that affects not just their housing behavior, but also their willingness and ability to buy other goods and services. So that's one of the reasons the declines in housing prices, and to some extent also stock prices, are part of the reason why consumers have been cautious and less willing to spend. The other major factor, of course, housing was a big reason for this crisis and recession. Of course, the other major factor was the financial crisis and its impact on credit markets. And that is another reason why the recovery has been somewhat slower than we would have hoped. As I discussed, the U.S. banking system is stronger than it was 3 years ago. The amount of capital in the banking system over the last 3 years has increased by something like $300 billion, very significant increase. And generally speaking, we're seeing credit terms getting a bit easier. We're seeing expansions in bank lending in a lot of categories. So there is certainly some improvement in banking and credit. Nevertheless, there are still some areas where credit remains tight. I've already talked about mortgages, where if you have anything less than a perfect credit score, it's awfully hard to get a mortgage these days. And other categories, like small businesses, have also found it difficult to get credit. And as well known, small businesses are an important creator of jobs, and so their inability to start a small business or to get credit to expand a small business is one of the reasons why job creation has been relatively slow. Another aspect of financial and credit markets has to do with the European situation, which I haven't gotten into. But following on the financial crisis in Europe, which was very severe alongside of ours, there's now a sort of a second stage whereby the solvency issues of a number of countries, the concerns about whether or not countries like Greece and Portugal and Ireland can pay their creditors, have led to some stressed financial conditions in Europe, and those have affected the U.S. by creating risk aversion and by volatility in the financial markets. That has also been a negative factor. I think a lesson worth drawing from this, and one I've
cited in testimony and elsewhere, is that monetary policy is a powerful tool, but it can't solve all the problems that there are. And in particular, what we're seeing in this recovery is a number of structural issues relating, for example, to the housing market, to the mortgage market, to banks, to credit extension, and of course to the European situation, where other kinds of policies, whether they're fiscal policies or housing policies or whatever they may be, are really needed to get the economy going again. So the Fed can provide stimulus, it can provide low interest rates, but monetary policy by itself can't solve important structural, fiscal, and other problems that affect the economy. All right, well, this is all a bit discouraging. Again, it's taken a while to get back to where we are, and we're still a long way from where we'd like to be. So let me just say a couple words about the long run. We did have, of course, a major trauma. The crisis is very deep. We have a lot of people who have been unemployed for a long time. About 40% or more of all the unemployed have been unemployed for 6 months or more. And if you're unemployed for 6 months or a year or 2 years, your skills will start to atrophy and your ability to get reemployed will decline. So that is a problem, clearly. And there are many other issues that the United States was facing even before the crisis, like federal budget deficits, and those have not gone away. In fact, they've gotten somewhat worse through the process of the recession. So clearly there's been some real headwinds for our economy. That said, I think it's really important to understand that our economy has faced many short-term shocks in the past, some not so short-term, but has been able to recover. We have a lot of strengths in this economy. It's, of course, the largest economy in the world. Between 20 and 25% of all output in the world is produced in the United States, even though we have something more like 6% of the world population or less. And the reason that we are so productive has to do with the diverse set of industries that we have, our entrepreneurial culture, which still is clearly the best in the world, the flexibility of our labor markets and our capital markets, and our technology, which remains one of our very strongest points. Increasingly, technology has been driving economic growth, and with some of the finest universities in the world and research centers and as a magnet for talented people from around the world, the United States has been very successful in the research and development area. So that has also been a source of ongoing growth and innovation in our economy. Now, again, we have weaknesses, and the financial crisis highlighted a few, but we've also tried, of course, to address that, and I'll come back to it, by strengthening our financial regulatory system. Here's a picture I find kind of interesting, just to put a little perspective on what we've been talking about for the last few lectures. The dashed line shows a constant growth rate of a little over 3% in real terms. So this is a log scale, so a straight line means a constant growth rate. And you can see that the United States economy, going back to 1900, has grown pretty consistently, around 3% for more than a century. You can see in the 1930s, you can see the big swing as the Great Depression pulled actual output below the trend line. And then you can see the movement above the trend line during World War II. But look what happened after World War II. We kind of went right back to the trend line. There were recessions and booms and busts in the post-war period, but remained pretty close to the trend line. Now, if you look to the very far right, you see where we are today. We are below the trend line. There are debates about whether or not that decline is in some way permanent. But I think there's a reasonable chance, looking at the long run of history, that the U.S. economy will return to healthy growth somewhere in the 3% range. There are factors to take into account, like changes in our population growth rate and our aging of our population and so on. But broadly speaking, what this picture shows is that over long periods of time, our economy has been successful in maintaining long-term economic growth. Let me just say a few words about regulatory changes. You recall that I discussed in the last couple of lectures the
the vulnerabilities in both the private and public sector in the financial system. On the public side, the crisis revealed many weaknesses in our regulatory system. We saw what happened with Lehman Brothers and AIG, and the too big to fail problem, the effects that they had on our system, and more generally the problem of lack of any attention to the broad stability of the system as opposed to individual parts of the system. So there has been a very substantial amount of financial regulatory reform in the United States. The biggest piece of legislation is the so-called Dodd-Frank Act. In the United States, I'm sure you know, legislation is named after the chairman of the relevant committees. Barney Frank was the head of the House Financial Services Committee when the Democrats controlled the House in 2010, and Senator Chris Dodd was the head of the the Senate Banking Committee. And so this Wall Street Reform and Consumer Protection Act passed in summer of 2010 was a comprehensive set of financial reforms addressing many of the vulnerabilities that I talked about earlier. Now, what were these vulnerabilities? Let me just remind you. One of them was the fact that there was nobody sort of watching the whole system, nobody looking at the entire financial system to look for risks and threats to overall financial stability. So the Dodd-Frank Act, one of the main themes of the Dodd-Frank Act is to try to create a systemic approach, one where regulators look at the whole system and not just individual components of it. So among doing that, among the tools to do that was the creation of a council called the Financial Stability Oversight Council, of which the Fed is a member, which helps regulators coordinate. We meet regularly in this council and discuss economic and financial developments and talk about ways that we can look at the whole system and try to avoid various kinds of problems. Moreover, the Dodd-Frank Act gave all regulators a responsibility to take into account broad systemic implications of their own individual regulatory and supervisory actions. And in particular, the Federal Reserve has greatly restructured our supervisory divisions so that we are looking now very comprehensively at a whole range of financial markets and financial institutions so that we have a big picture that we didn't have before the crisis. I mentioned in the discussion of vulnerabilities the many gaps in the financial system. There were important firms like AIG, for example, but others as well, that really had no significant comprehensive oversight by any regulatory agency. The Dodd-Frank Act provides kind of a fail-safe in that the Financial Stability Oversight Council can designate by vote, can designate any institution which it views as not being adequately regulated to come under the supervision of the Federal Reserve. And that's a process that's going on now. So there will not be any more large, complex, systemically critical firms that have no oversight. Likewise, the FSOC can also designate so-called financial market utilities like a stock exchange or some other major exchange to be supervised by the Fed and other agencies. So those gaps are getting closed. We won't have the situation that we had before the crisis. Another set of problems had to do with too big to fail and dealing with firms that are systemically critical. The approach to dealing with too big to fail or systemically critical institutions is two-pronged. On the one hand, under Dodd-Frank, large, complex, systemically important financial institutions are going to face tougher supervision and regulation than other firms. The Federal Reserve, working with international regulators, has established higher capital requirements that these firms will be subject to, including surcharges for the very largest and most systemic firms. Rules like the Volcker Rule, which prohibit bank affiliates from taking risky bets on their own account, will try to reduce the riskiness of large firms. Stress tests I talked about will be conducted. Dodd-Frank requires that large firms be stress tested by the Fed once a year and conduct their own stress tests once a year. So we'll be comfortable, or at least more comfortable,
that these firms can withstand a major shock to the financial system. Now, one part of tackling too big to fail is by bringing these large, complex firms under tougher scrutiny. More supervision, more capital, more stress tests, more restrictions on their activities. But the other side of too big to fail is, well, failing. In the crisis, the Fed and the other financial agencies faced the very bad choice of either trying to prevent some large firms like AIG from failing, which was a bad choice because it ratified too big to fail and meant that the firm was not really punished for, adequately punished for the risk that it took. But the alternative would be to let it fail and to have huge consequences for the whole financial system and the economy. So that's a too big to fail problem. The only way to solve that problem in the end is to make it safe for a big firm to fail. And one of the main elements of the Dodd-Frank Act is what's called the Orderly Liquidation Authority, which has been given to the FDIC. As you probably know, the FDIC already has the authority to shut a failing bank, and it can do that quickly and efficiently over the weekend typically, and depositors are made whole, and the FDIC's ability to do that has avoided panics and bank runs since the 1930s. Well, the idea here is that the FDIC will do something similar, but instead it'll do it for large, complex firms, which obviously is much tougher. But in cooperation with the Fed and with regulators from other countries, where in case of multinational firms, work is underway to prepare so that should it happen that a large firm comes to the brink of insolvency and cannot find an answer, cannot find new capital, for example, that the ability of the Fed to intervene the way we did in 2008 has been taken away. We can't do it legally anymore. The only option we will have is to work with the FDIC to safely wind down the firm, and that will ultimately reduce, or we hope eliminate, the too big to fail problem. There are many other aspects of the Dodd-Frank Act. Remember, I talked about another vulnerability was the exotic financial instruments, derivatives, and so on that concentrated risk. There's a whole set of new rules that require more transparency about derivatives position, standardizations of derivatives, trading of derivatives through third parties called central counterparties. The idea here is to take derivatives and those transactions out of the shadows, make them available and visible to both the regulators and to the markets, to avoid a situation like we saw during the crisis. One of the shortcomings, and again here the Federal Reserve did not do as good a job as it should have in protecting consumers on the mortgage front. So the Dodd-Frank Act creates a new agency called the Consumer Financial Protection Bureau, which is meant to protect consumers in their financial dealings, and that would include things like protections on the terms of mortgages, for example. So there's quite a variety of these of aspects of Dodd-Frank. It's a large and complex bill. A lot of complaining about the fact that it is large and complex. The regulators are doing their best to implement these rules in a way that will be both effective and at the same time minimize the cost to the industry and to the economy. That's difficult, but it's an ongoing process. We do that through an extensive process of putting out proposed rules, gathering comments from the public, looking at those comments, making changes to the rules, and so on. And so it's an iterative process by which we develop these regulatory, to put into place these regulatory standards. And again, it's still very much underway. So finally, let me just conclude by saying just a couple things about the future. Central banks, obviously, not just the United States, but around the world, have been through a very difficult and dramatic period, and has required a lot of rethinking about how we manage policy, how we manage our responsibilities with respect to the financial system.
In particular, during much of the World War II period, because things were relatively stable, because financial crises were something that happened in emerging markets and not in developed countries, many central banks began to view financial stability policy as kind of a junior partner to monetary policy. It was not as important. It was something that attention was paid to, but it was not something that the same amount of resources and attention was paid to. Obviously, based on the crisis and what happened and the effects that we're still feeling, it's now clear that maintaining financial stability is just as important a responsibility as monetary and economic stability. And indeed, this is very much a return to the where the Fed came from in the beginning. Remember, the reason the Fed was created was to try to reduce the incidence of financial panics. So financial stability was the original goal of creation of the Fed. So now we sort of come full circle. So financial crises will always be with us. That is probably unavoidable. We've had financial crises for 600 years in the Western world. Periodically, there are going to be bubbles or other instabilities in the financial system. But given what the potential for damage is now, as we've seen, it's really important for central banks and other regulators to do all we can, first to try to anticipate or prevent a crisis, but if a crisis happens, to mitigate it and to make sure the system is strong enough that it'll be able to make it through the crisis intact. So again, we began by noting the two principal tools of central banks: serving as lender of last resort to prevent or mitigate financial crises, and using monetary policy to enhance economic stability. In the Great Depression, as I described, those tools were not used appropriately. But in this episode, the Fed and other central banks, and I should say that there's been a great convergence that other major central banks have followed, or on their own have followed very similar policies to that of the Fed, that these tools have been used actively, and in my belief, in any case, by doing that, we avoided much worse outcomes in terms of both the financial crisis and the depth and severity of the resulting recession. A new regulatory framework will be helpful, but again, it's not going to solve the problem. The only solution in the end is for us regulators and our successors to continue to monitor the entire financial system and to try to identify problems and to respond to them using the tools that we have. Okay, so those are my comments. We have some time, and I'd be happy to take your questions. Kelly.
Thank you, Dr. Bernanke. My name is Kelly Quinn. In the first class, you touched upon the Main Street versus Wall Street divide, and this has been in the back of my mind throughout the lecture series. You've talked about the importance of educating the public on monetary policy, and although this lecture series has definitely demystified the Fed for me, I think it's really been Wall Street, not Main Street, that's been tuning in. So given how unpopular bank bailouts were among many Americans struggling to pay their mortgages who don't really understand the importance of financial stability, do you ever see Americans reconciling these differences?
Well, you're right that some of the same conflicts that we saw in the 19th century, that you see echoes of them today as well. I don't have a simple answer to that question. As you know, the Fed has done more outreach, the press conferences and other kinds of tools to try to explain what we did and what we're doing. Clearly, the Fed is very accountable. We testify frequently, not just myself, but other members of the board or Reserve Bank presidents. We give speeches. We appear in various events and so on. It's inherently difficult because the Fed is a complicated institution, and as you've seen in the last 4 lectures, these are not simple issues.
But all we can do, I think, is do our best and hope that our educators and our media and so on will, begin to carry the story and help people understand better. So it is a difficult challenge. It is a difficult challenge, and it does reflect a tension that has been in U.S. American feelings about central banks ever since the beginning. Sorry, Andres.
Thank you, Mr. Chairman. My name is Andres. Earlier you mentioned that the Fed had several ways to unwind the large purchases of scale of assets, including selling them back into the market.
Mm-hmm.
What guarantees that investors will be willing to buy them back in the future?
Mm-hmm. Well, again, first of all, we have essentially 3 separate types of tools that we can use, any of which by themselves would actually allow us to unwind our policies, but taken together, I think, gives us a lot of comfort. First of all, we have the ability to pay interest on the reserves that banks hold with us. So when the time comes, whenever that time may come, whenever the time comes for the Fed to raise interest rates, we can do so by raising the rate of interest we pay to banks on those reserves. Banks are not going to lend out the reserves at a rate lower than what they can earn at the Fed, and so that will lock up those reserves, raise interest rates, and serve to tighten monetary policy. So that one tool by itself, even if our balance sheet stayed large, could tighten monetary policy. The second tool we have is what's called draining tools, and I won't get much into this, but basically we have various ways that we can drain the reserves from the banking system and replace them with other kinds of liabilities, even as, again, the total amount of assets on our balance sheet is unchanged. So the third and final option is either to let the assets either run off as they mature or to sell them. And these are Treasury securities, these are government guaranteed securities. It's certainly possible that the interest rate that will prevail when we sell those securities will be higher than it is today. In other words, we'll have to pay a higher interest rate in order to make investors willing to acquire them. But actually, that'll be part of the process, right? That'll be a time when we're trying to raise interest rates. It'll be the reverse of what we did when we bought them. At that point, we'll be trying to raise interest rates in order to exit from the easy policy into a policy that will allow the economy to grow in a low inflationary way. So I don't think there's any danger that investors won't buy the assets. They'll certainly buy them at a higher interest rate, and that, in a way, would be part of the objective of reducing the balance sheet, would be to tighten financial conditions so as to avoid inflation concerns in the future. Noah.
Thank you. So I read an article, and I'm sorry I don't remember the exact source, and it outlaid a plan to allow homeowners who have been on time with their mortgage payments to refinance at the current lower rates, sort of as a way to protect them from their housing prices dropping. So I was wondering whether you've heard of plans like that and what sort of involvement the Fed would have, or whether that would fall to the Consumer Protection Agency.
So there are some programs like that. One in particular is called the HARP, H-A-R-P program, and that's run by the GSEs, Fannie and Freddie, and by their regulator, which is called the FHFA. And on this program, if you are underwater in your mortgage, in other words, if you owe more on your mortgage than your house is worth, you still may be able, under this program, if your mortgage is held by Fannie or Freddie, you may be able to refinance at a lower interest rate, which will reduce your payments. So that program is underway and being expanded. It doesn't necessarily work if your mortgage is being held by a bank, because they're not part of this program, but they may choose voluntarily to do it, but you might be out of luck if your mortgage is not held by Fannie and Freddie. So yes, there are programs like that. Fed is not involved in them. I mean, our job has been to keep the mortgage rate low and hope that we can help homeowners. But programs like that, which allow people to get lower payments, obviously are going to be helpful to those people because they'll face less financial stress and
maybe a smaller chance that they'll end up being delinquent on their mortgage.
Hi, I'm Michael Feinberg. Thank you very much, Chairman. You mentioned in your lecture the dangers of deflation from the Great Depression and more recently in Japan. And one of the arguments for maintaining a target inflation rate above 0 is to provide a cushion against the possibility of deflation. Yet in the last 2 recessions in the United States, there's been a pretty significant fear of deflation, causing the Fed to keep monetary policy very accommodative in the beginning of the last decade and even more so at this point. Do you think that 2% is enough of a cushion to prevent deflation, and have you considered higher inflation target rates? Thank you.
Well, that's a great question, and there's been a lot of research on it. It seems like the international consensus is pretty much around 2%. I mean, almost all central banks that have a target either have a 2% target or a 1 to 3% target or something like that. And there's a trade-off here, because on the one hand, you want to have it above 0, as you say, in order to avoid or reduce deflation risk. But on the other hand, if inflation is too high, it's going to create problems for markets. It's going to make the economy less efficient. And so there's a trade-off. You know, what level of inflation gives you at least some reasonable buffer against deflation, but it's not so high that it makes markets work less well. And so again, the international consensus has been around 2%, and that's sort of where the Fed has been informally for quite a while. So that's what we announced, and that's for foreseeable future. That's where we plan to stay. But it's obviously an issue that researchers will continue to look at, trying to address exactly that trade-off that you're referring to. Yeah, you.
Thank you, Chairman Bernanke. My name is Yuki Wu. You mentioned one of the biggest lessons you learned from the recent financial crisis is monetary policy is powerful, but it cannot solve all the problems, especially like the structure problems. So what do you think are the effective tools that can be used to solve these structural problems in like housing and financial and credit markets? Thank you.
Well, it depends on the particular set of problems. So in the case of housing, the Federal Reserve staff wrote a white paper which analyzed a number of the issues, talked about not just foreclosures, but also issues like what do you do with empty houses, talked about issues of how you get more appropriate mortgage origination conditions, things of that sort. We didn't come down with a list of actual recommendations, because that's really up to Congress and to other agencies to determine. But we did go through a whole list of possible approaches, which I guess I won't try to do here. But housing is a very complex problem, and there are many different things that could be done to try to make it work better. And indeed, looking forward, given the problems with Fannie and Freddie, we have some very big decisions as a country to make about what our housing finance system is going to look like in the longer term. So a lot of issues there. On Europe, for example, there's been a very complex problem. We've been in close discussions with our European colleagues. They've taken a number of steps there right now, talking about the so-called firewall, how much money they're going to contribute to provide as protection against the possibility of contagion if some country defaults or fails to pay its bills. So each one of these issues has its own approach. In the labor market, we have the problem of people who've been out of work for a long time. Obviously, one of the best ways to deal with that would be through various forms of training, increasing skills. So you could just go down the list. And basically anything that makes our economy more productive and more efficient and deals with some of these long-term issues related to our fiscal problems, those are all things that would help. And the fact that the Fed is doing what we can to try to support the recovery, shouldn't mean that no other policies are undertaken. I think it's important that we look across the entire government and ask, what kinds of constructive steps can be taken to make our economy stronger, to help the recovery be more sustainable. Yeah.
Thank you, Chairman. So you mentioned that the Fed is doing what it can to, to sustain the recovery, and but with unemployment at 8.3% and the housing issues that you mentioned very sluggish, and the problems in Europe, what other tools do you think the Fed has to potentially fight off other issues that we're going to have in the future?
Give me an example.
I mean that's, I guess, with if other issues just other issues that, let's say, unemployment decides to rise, or the housing recovery gets worse, or Portugal, Spain, and Italy, all three of those issues. So
now it cost me a night's sleep now. Well, what I described today was basically, in these lectures, is basically what the toolkit is for the Federal Reserve and other central banks. I mean, we have lender of last resort authority. We still have that. It's been modified in some ways by Dodd-Frank, but strengthened in some ways and reduced in some ways. Between that and our financial regulatory authorities, we want to make sure our financial system is strong, and we've worked particularly hard to make sure that we do everything we can to protect our financial system and our economy from anything that might happen in Europe. So that whole set of tools is still very much available and in play should there be any new problems in financial markets. Then on the monetary side, I've described to you, I don't have any completely new monetary tools, but we have the tools we've used and our interest rate policies, and we can continue to use monetary policy as appropriate as the outlook changes to try to achieve the appropriate recovery while still maintaining price stability, which is, of course, the other half of the Federal Reserve's mandate. So we have these two basic sets of tools. We'll have to continue to use them and continue to evaluate where the economy is going and use them appropriately. We don't have lots of other tools, and that's why I was saying earlier that we really need an effort across different parts of the government and indeed the private sector to do what can be done to get our economy back on its feet. Max. I think this has to be the last question.
Thank you, Dr. Chairman. You spoke a lot about the economic recovery and that while it is painfully slow, there is clear recovery happening. My question is, what are the key indicators that you and the Federal Reserve are looking at that would suggest that the private sector has begun self-sustaining this economic recovery and that the Fed may begin to tighten monetary policy?
Mm-hmm. Well, that's a great question. So, first, one set of indicators that has been looking better lately, and we've been paying a lot of attention to, is developments in the labor market. Jobs, unemployment rate, unemployment insurance claims, hours of work. All those indicators suggest that the labor market is strengthening, and indeed, employment is one of our two mandates, one of our two objectives. So clearly, that's something we'd like to see sustained, and we'd like to see continued improvement in the labor market. As I talked about in a speech I gave on Monday, it's much more likely that that will be sustained if we also see increases in overall demand and overall growth. So we'll continue to look at indicators of consumer spending and consumer sentiment, capital plans, capital expenditures, indicators of optimism on the part of firms, those kinds of things, to see where production and demand are going to go. And then, of course, as always, we have to look at the inflation side and be comfortable that price stability will be maintained and that inflation will be low and stable. So those are the things we'll be looking at, and there's no simple formula, but as the economy strengthens then and becomes more self-sustaining, then at some point, obviously, the need for so much support from the Fed will begin to diminish. I really want to express my appreciation for for this class. I think you guys have been really obviously engaged, and your questions have been terrific, and thanks for giving me this chance. Thank you.
There's a couple things I'd like to say before we all run off. And first of all, I would like to acknowledge a special guest that is here today. In early December, I had an email from Susan Phillips, about the Federal Reserve's interest of having Chairman Bernanke come over to GW and do some presentations, which is about as specific as we were at the time. Susan Phillips is the former dean of the GW Business School and also a former Federal Reserve governor, and she's the matchmaker. She's the one who made this happen. So welcome, and we thank you very much for what you did to make this happen. Second, obviously, I have to thank the chairman and also the chairman's staff. At every turn over the last 3 months, I kept getting the same message from them, which was, Tim, this is your class. And I think that's extraordinary. I mean, when you get into this, agreeing to do this kind of a program, frankly, you wonder whether a powerful organization like that might run over you. They never did. And maybe it's because their boss is a professor himself, but I could not possibly have asked for a better group of people who are more respectful of the educational process in all of the planning that went into this, capped by 4 very stimulating lectures that the chairman gave. And so I would like to thank the Federal Reserve and the chairman for all of that as well. Third, there's a lot of people at GW that did a heck of a lot of work for this, from information technology to media relations and everybody in between. So thank you all for that. And then finally, by the way, students and faculty, remember we're going next door. We have a small little gathering with the chairman. But I know that there's some people in the back row here and also some people who are watching here who have been enjoying this. And I just want to let you know the class has just begun. We're going to be having an engaged dialogue next week on the chairman's remarks, and then we're going to be looking at other issues pertaining to the Fed, the constitutionality of the Fed, its independence from the political sector, from the banking sector, China, Europe, sociology of finance, Consumer Protection Bureau, and even whether the Fed and central banking might have an impact on reducing violence in the world. I mean, we've got a full agenda here. And so, I mean, I welcome you to come back. It won't be live streamed on the Fed, but we will be recording these and posting on the GW website so you can watch it afterwards. So this has been a fabulous start, as fabulous of a start as any class could possibly imagine to begin. But we've got a lot to go, and we've got some of the finest professors around this university that are going to come in, and so I encourage you to hang around. It's going to be a great ride. So again, thank you, Mr. Chairman. Thank you all for coming, and look forward to the rest of the class.